Hey, thanks for the check 1 2 mic check. Test 1 2 mic check. Good. There we go. My monitor is like, I'm always turning it off. All right, what do you got going on here?
It's off the back of the Canadian rate decision there and the release of the rate statement.
Bears telling you scary stories before you go to bed.
To keep in mind, National Economic Council's Hassett, currently speaking on CNBC, says GDP data shows a strong growth.
Telling you nightmare stories. Telling you about all the bad things out there.
White House's Hassett says the data shows imported good prices dropped.
Good morning out there. How are you all doing? We have a lot to go over today. We have a ton to go over. Think tight here. It's been like this. It's been this.
Donald J.
You kind of expect this.
Really me. And I'm going to do a little advert for Financial Juice.
Let me turn this off. This nonsense off. I gotta complain to these guys. Like, listening to that all day long. I mean, I thought it was kind of funny the first time I heard it, but like the 500th time, I was like, it was a little bit too much here. Hold on here. I just want to do one quick thing. Get shareable link. I'm gonna post. I don't do a ton of self promotion. I don't do any, to be honest, and I don't like it. But this seems to be one of the larger events of the month where people want to tune in and get a primer for these FOMC meetings. Now, this meeting, like the last couple, but this one in particular, seems like it may be slightly less benign than expected. I was looking at the expected move for this week. It's low. It's 1%. Not this week, but into the first. Ironically, not I don't know if it's ironically, but interestingly, the first. I'm always interested in when the date of the month date ends and the day of the week that the month ends. And in this month in particular, it ends, the 31st ends Thursday, and then we have the 1st. On the 1st of August is on Friday. And I was looking at a seasonality calendar, and August starts to become less profitable. September is traditionally red month, bad month. Returns in August are not good. With a caveat, there are some bull trades in August. There are a couple places you can buy a dip, even though we're typically or on historically rolling over into September. And what I found fascinating was that on the 1st, there's on average a huge sweep of bullishness on that date, like the 1st. I don't know if that coincides with a door opening, a gamma wall opening after the month-end expiry. So maybe there's a print on the 1st, which falls on a Friday this year. only to come back, let's say on Monday, down significantly, because the second, third, fourth are horrible that whole week. So it'll be interesting to see if we open on a high on Friday open, or close Friday on a high, come back to a bloodbath on Monday, and you've got a few days of catch up to do with the weekend too, right? Some blood over that weekend, or if we get it started earlier too. We'll take a look at the charts and see what this looks like. And there's potentially a bull trap and potentially a bear trap in here somewhere. Either they get this print early to the upside, or we come back for it on the back end. Is possible in the month of August as well, before a major roll. There's a couple of ways this could work itself out. But I do want you to realize that the market is positioned for more upside. And I was in a conversation. Let's switch over here to the main screen here. We got a lot to get through. So, when you're in trend, right? When you're in trend, from quarter to quarter, let's say, right? And matter of fact, we had a great example of this year. In mid-February, we knew that we were coming into seasonal weakness. We said, "Hey, let's get hedged up." We're expecting a major correction. I don't think anyone thought it was as deep it was going to go, but it went deep. I think we knew it wasn't going to be a normal correction. We knew it wasn't like a correction. It was going to be major. Just not as deep, like 10%, maybe 12 or 15, worst case scenario on a wick, right? We went 20. Quick, fast. This wasn't like a whole year operation. This was not too much time at all, right? Just a couple months, and maybe a little bit longer than that, but it was really hard, really straight down, and brutal. What was fascinating about that time period, it was a very clean way to look at attempts to change trend. And we're going to talk about that the first thing this morning, because I want to be able to visualize for you what it means. Think tower here real quick. I want to visualize, or I want you to be able to visualize what it means to be in trend and what it takes to reverse trend. And let's go look at this really quick if you can. Now, I'm not going to look up the exact dates with you, but you can do this on your own. You can find the finer details at home. But we're going to look at like a 4-hour here and go down. And this has something to do with a conversation I had. I had a very long conversation yesterday after the show with a friend, a guy that I trust. And here we can come in here. And we'll just look at this right here. And this is kind of important. It's hard. I don't know if it's hard. People, for some reason, tend to have a hard time visualizing or understanding these concepts sometimes. So this is an easy way to look at it. So this is middle of February of this year, and we're already going into risk-off mode, which is kind of similar to where we are right now, right? Twice a year you get two times of the year that are expected seasonal weakness, okay? And if you're in a bull market or a bull run, you respect those things. The same thing applies in a bear market. If you're in the inverse, if you're in a bear market, you typically get at least two decent buys. You can survive in a bear market if you're a bull. You really can. And you can make some great trades. Especially in negative volatility and big volatility. Some of your biggest, some of your largest squeezes are in bear markets. So they can be very profitable for you if you're a bull, just trying to make it in a bear world, right? Now, if you as we head into this time frame where we're about to go risk off, right? We begin to roll down, and you can do this on your own. I think I've shown this on the show in the past, but whenever you're coming into 2 times a month and quarter, when you come into Vixpiration and OPEX and month end, there are opportunities, and we're in a downtrend here, right? There are opportunities to reverse trend that are given. In particular, if you look at this one here, this is March. We come into Vixpiration, OPEX, and month end. And this is end of March right here. And we're in a downtrend. And so the market gives the opportunity at a quarter or a month end to reverse or change trend, direction, and market. And you can see the attempt in here. And I want you to think about this, because when you unwind, in this instance, hey, we're going into seasonal weakness, we're going to change trend to bear trend, and we're going to give you the opportunity to unwind convincingly. And that means that as you come into these Vixpiration OPEX periods, that you would see a reversal, right? And you kind of need this escape velocity. It's not just that you're escaping trend. You need to convincingly, in that allotted window of strength or weakness, you can call it whatever you want. I think it's a misnomer to say window of weakness. It's more just a window of movement. The markets, the options market structure, and remember this point, the options market loosens up a little bit, where everyone's wound into position and sentiment, and we're going here and we're all piling into this target. And then there's this opportunity in here where if sentiment changes, if positioning changes, if outlook changes, you're given the chance to roll your positions into, in this case, a more bullish positioning. And then, of course, we didn't get that, right? We still had more uncertainty. They rolled us right back down. The positioning became more bearish, more uncertain. And as those new trades came in, we got back into trend and we continued lower. Fascinatingly enough, we made the attempt again down here. We made the attempt to break out again, right? This is OPEX and Vixpiration. And then back down here into April, this is where we get to month end. Here's the 30th. And notice in this case, we're already breaking out of trend. And convincingly, once we get there, there's no turning back to the downside. And this shows the idea that, and this shows a couple things. One, on a quarterly basis, we couldn't break trend. And then it took one more month into the next quarter to change trend. And most of this is due to, hey, we've done 20% down. That seems like enough. And some of the uncertainty is leaving, right? And we've punitively damaged the market for uncertainty and potential danger down the road and all this other stuff. We're coming into the summer trade, and we're also coming into the end of a typically bearish season, like the end of it. We're in the tail end of this expected seasonal weakness. And so positioning changed. And all these things are kind of important. Why? Well, currently we're sitting in this new trend, right? And we start the new bearish season, believe it or not, in June. in right around OPEX and expiration in June month end. And what you're looking for is, hey, what's sentiment out there? We're at the beginning of the bearish season. Is everybody bearish here? Do they think the market has more legs? Or do they think the market doesn't have more legs? Do they think that doom and gloom is coming? And you get the bear thesis, and they write the big book for you and all this other stuff. But you're also watching for price action to, I don't know if it's bookend, but to match the narratives that you're told at the end of June. And you're also watching price action for, in this case, some kind of meaningful break of trend, right? You're looking for that starting back here in June OPEX, right? June expiration, and instead, what do? And they attempted to break trend. You can see it right here. Remember this whole convincingly thing. Right, so we swoop down. Is sentiment changing? Nope, it's not. We're rolling our stuff higher. And we stay on trend another month. Now, if you've got seasonal weakness or seasonal bear, you know, like, hey, we're going to get a pull. You know, you guys all know what September is, October, and November. And so when you come into July, you're like, nope, you know what? We're still think we can go higher here, right? So we trade this all the way up. And if you have like a curve of, so remember this is end of June, you're like, that doesn't matter, Cap. Yeah, it does. It matters into the first weeks of July, and it matters into the middle of July. So if you have like the beginning of the season of volatility, bond markets, oil, and then you've got the end of seasonal weakness, right? It's going to be like the start here in July. You get to like the end of July, then you get to August, then you get September, right? Then you get to October down here, maybe November over here. You get this big, nice curve of seasonal weakness. And the closer that we get to this, midpoint or roll or back end of this, if we have not rolled, the market demands more and more for this roll to happen. It's kind of like the inverse of March and April. And I think we had like that last, I don't know, they keep calling it Liberation Day. I thought that was stupid, but every month and every quarter in the spring, or late winter and early spring and late spring, we just waited until the month end to see if we had a confirmed breakout. You know, in the inverse of this would be, you know, did we break the inverse of this, or in this case it would be, did we break trend? Did we make some new lows? Are we starting to roll this bad boy over? And you look for it again at the end of July and the end of course, in August and September. Now, some years we roll early. Other years we roll in the middle of summer. Sometimes we roll in July, sometimes we roll in August, sometimes we roll in September. It can actually last until the end of September. We even had a bearish season 2 years ago, maybe, where we're expecting to roll in mid-February to the downside, and we wound up going vertical into, I think, March 29th. We went straight up. So there's no like, we're going to do this exactly on this date. We have a window. We also know that if we go in the opposite direction, let's say we go up longer than expected, all of it is coming back. So if we were to, let's say, roll today, well, let's say we rolled on this past Monday was the high. You shouldn't expect more than 4 or 5% down from that high on Monday. If we were to continue higher with spot up, vol up, you'd expect then 7%, 8%. You know, the higher we go, all of that stuff typically comes back in brutal fashion. The more that you stay out of the average or the mean or the curve of expectation within that time frame. if you keep going up when you're supposed to be going down, all that shit's coming back. If you keep going down when you're expected to turn around 20% in the spring, you should conversely expect a fucking vertical move up, right? Kind of the same deal, right? You do that much damage in that short a period of time, you're going to expect once it does unwind, this is back in April, you're going to expect once that unwind does happen that conversely it's going to go vertical, because of so much damage. And that is what took place, isn't it? And so now we're finding ourselves in this same similar situation again. And this happens every year, twice a year. Every year. It's like clockwork. So if you're not aware of that, I know most of you are, but I know a lot of you are not. Seasonality. It may not be perfect, but it gives you an idea, right? So people that aren't deep in the stock market, or they're not eating, shitting, and living the stock market 24 hours a day, probably would help you, right? I know I can come in a bull market twice a year, and there should be some kind of everybody's hair on fire, and I'll go in there and I'll buy a low. Not that hard. Not rocket science. You don't need a finance degree to know that. And so as we are looking here, we're looking each month as we head into this in this case, this period of thought to be seasonal weakness, and we're looking for signs of it when? During Vixpiration and OPEX, and then into what? Month end. And the first week of the new month. So in this case, we're in an uptrend. So what would be a hallmark of that? If we're in a downtrend, the hallmark would be as you get closer to the end of the month or end of a quarter, you would see the market come higher or have this huge down move and then start rising higher in an attempt to break out. And if it can't break out, we're going to continue to the downside. The same thing is happening. It happens every month, every quarter, every year. And so we're now where? Today is July 30th. We got one more day of the month. You want to check and see what kind of progress has been made from sell side, from Vixpiration, OPEX, and month end. And the longer that we stay, invariably positive, the more the chance becomes that we do this roll in this time period. But if we don't do it now, or we don't have a significant pullback next week or the week after, you're then looking towards September or October. There are other signs you're looking for too. Let's say we do break trend, so we start bleeding out and it's horrible next 2 weeks. How far down do we go? Do we get sucked back up into trend to the upside? Do we make another all-time high? Is the worst not coming until September? Is the worst in August? Like, where is the worst? Does it take us 2 months? Do we spend August and September giving back 4 to 5%? That sounds like an eye bleeder to me. But whatever. It's what it is. There are some takeaways, though. We can watch trend and see. Number one, we know that sellers or anyone is going to try to change trend as we come into a month end. Vixpiration, OPEX, especially for an uptrend, right? Especially going into a bear seasonality. The second thing that we're looking for here is how much down would you expect? And the other thing that you're asking yourself is, what does the option market look like? You're looking for, just like in this early or late winter, early spring, you're looking for what is sentiment? Is sentiment changing? Do you think that we can trade? We've seen, it's ironic because this week, not ironic, it's expected. Up until this week, calls were rolled higher and higher and higher. calls rolled to 6,000, or as an example, calls rolled to 5,900, then calls rolled to 6,000, then calls rolled to 6,100, then 6,200. And along the way, you're asking people, do you think we can trade higher? Yes, no. And then you watch the calls rolled higher. You go, well, they told me this and they told me that, but they're rolling their calls higher. And that's insightful as well. And up until, I don't know, 2-3 weeks ago, calls were being rolled higher. They were being rolled to 6,400. There was some roll to 6,500. Then there was a back and forth. And then we started to shift to 6,450. This is large concentration on SPX 6,450. And that means something. It means that you, the trader, do not believe that we can trade over 6,500 to 6,600. It starts to put a top in the market. And then you begin to rein in your expectations where you're like, well, you know what? I'll lower from, I'm gonna instead of being at 65, I'm gonna roll back to 6,450. What are you doing, Bob? Well, I'm gonna stay at 6,400. Mike, what are you doing? I'm at 6,300, bro. But none of these people are saying that they're at 66, 65, 66, 67, and that does mark almost at best case scenario sideways into a roll with some volatility expected, right? Seasonally, at least. So this looks right. This looks correct. That the topping process has begun. Now, something has not happened as of yet. There has not been any roll lower. There's been hedges put on the market. As a matter of fact, a bunch of you are angry, right? You want your hedges to print now. I don't want them to print on October 31st or September 15th or any of that. I want the print today. So you can start to hear that cacophony of market's going to roll, market's going to roll, market's going to roll, market's going to roll. Now, the option market disagrees. The option market's saying, we're going to start flattening out here. Oh, and we still have some targets higher. It was 6,500. Now it's 6,450. And the dealers don't want to print that until they're worthless. When are they worthless? End of month, right? The 1st. Somewhere in there, somewhere when they're dead. Like murdering all those options are great, right? You placed bets to 6,500. You placed bets to 6,450. I'll print it wherever you are, but I'm not printing it until they're worthless. So we got a little bit of that going on. We got a little bit of a dangling sausage at 6,500 to keep the market alive. And I asked you, I think a week or two ago, I said, eventually they're not going to need that sausage. They only need the sausage to get you to 6,400. Once you're there, just take it away. It's gone. And the bull market's alive for that. And where did we open on Monday? 6,420 or something on SPX. Went from Sunday to Monday. It was the briefest moment in time. Dealers got you there and me there, and yet it was brief. You didn't hang out there. There was no partying up there. None of that. Hey, we printed it. Bye-bye. We're out of here. And now all of a sudden that carrot of 6,500 is kind of being faded, right? And you still have people bullish here. Still. The prominent gamma bar right now is 6,450. I'm going to show it to you really quick here. Get rid of this here. Hang tight here. Get rid of that right here. And let's look at this bar right here. 6,500. Still there on net gamma. Let's look at SPX 2-date and 1-date. We'll look at both. Net gamma for 1-date. This is for SPX. 6,400. 6,410. This is 1-date. What are we trading right now? We ain't trading 6,400. That's not lower. These aren't gone. There's still some bulls here. If we look at volume, 2-date volume, what do we got going on here with 2-date volume? 6,430. Up here, still have some bulls out there. 6,575. Why are these people still here if we're going to roll? I don't know. Maybe you can tell me. So there's still some hopium from bulls. Still a little bit. It's going to take time or some red bars to change that narrative. So it's kind of wonky right now looking at all of that stuff. And also you've got systematics out there, CTAs. They're still buyers. CTAs still buyers right now. Look at them. They're not going to be buyers at the end of the month, but they're buyers today. Flat tape, up tape, buyers. Look at vol control, same thing. They're here. Starting to flatten out, though. You can kind of see a flatten here. And that's not until we get into what? August. And this month is almost over, isn't it? So you've got a little bit of hopium left by bulls. You start to get a little bit of flattening by COTs. And then you got one. The only other thing I see here that's maybe bullish would be asset managers. And they are behind the curve right now. You can see them right here. They're slightly behind the curve. Now, these entities do become sellers on a down tape. On a flat tape and an up tape, they're buyers right now into month end. But as we come into the new month, the 1st, the 2nd, the 3rd, the 4th, and the 5th, they stop being buyers. And in a down tape, they become sellers. So the mechanics are there to top, to take us into some kind of a roll over the next 2 months. I think everybody's aware of it. But the gamma market's not quite there yet. So I was talking to a buddy yesterday about all of this, and I'm like, we're going to do it. I'm like, I just don't know when. And we're discussing two things. Are we topping, and is the top in? And my first comment was, we are definitely topping. You can see it in the options market. Is the top in? I can't guarantee that it is. I can't say it is. And not only that, there's a bunch of stuff that we haven't done yet. If you look just right here, this is trend, right? This is that same trend. Trend matters. I know you all love to be like, hey, I got a gold star in Elliott Wave. I got a gold star in ICT. I got a gold star in Gamma. I got a gold star in Greeks. 2nd, 3rd, 5th, 10 orders of Greeks. There's no such thing as that, but you get it, right? Whatever it is that you're into. And this is simple. Trend. Trend matters. It really does. Is it something where you can predict from it? Not well, not with an edge, but it shows you a story. And so what do we have happening right now in this trend? And we're expecting a roll, right? Let's look at it. We're in trend. We make this big giant print up here, right? We didn't start crashing down here. We're sitting on this island in the sky right here of support. You can see it right here. It's crystal clear. And what do you call what does the street call them? Punters? Yeah, they're punting. Up print. Up print. Up print. Up print. This is also selling probably too, right? Getting out, taking my money and running. taking my money and running. Right? You can see all the bulls leaving the market. There's another one right there. There's a dark print. This is the unlit markets where, hey, I'm going to get some money here, right? And meanwhile, you're just like this. Bam, bam. But we have not broken trend yet. We haven't broken down in here. There hasn't been like 2 red bars in a day out of trend. So is the top in? Becomes the bigger question. Is the top in? No one knows. Anyone out there telling you this was top is out of their fucking skull. The options market doesn't say that the top is in. The options market, as a matter of fact, says there's one more ramp in here. That's what it says. It also says, we get into like March 31st right here. There's actually a window for the ramp to sell down. That's what the option market says today. So you need sentiment shift. Now, is the top in? It may be. But the options market sentiment is not that. So is there threat of a all-time high again? As of today, yes. And it gets worse. I mean, in a good way for a new all-time high as we approach monthly expiry. There's a window for it as we approach July 31st and August 1st, 2nd, 3rd. And history tells us that same thing. If you look on the averages for August, there's usually an up day of how much? 1.5%. An up day on August 1st. On average, it's like super prevalent. So what they'll do is that oftentimes, historically, is they'll come in, fuck you here, tell you that's going to happen. They ram it up your ass. Then you get your roll. So they take all your puts and they destroy them because they don't want to print your puts either. Just like they don't want to print these calls. They don't want to print these puts either. That's their job. Neutral. Take all your money, literally. That's what it's all. The game's all about. Now, can this dissipate? Yes. You have events, data along the way that if they become more bearish or more volatile or uncertain, can shake you as a bull and say, you know what, bro, you're the last holdout bull here. You need to pack it up. Look at all this horrible stuff. Durable goods was bad. JOLTS was bad. GDP was bad. Treasury refinance announcement was bad. FOMC was bad. PCE terrible. NFP horrible. Just more bad. And so far we haven't had that, have we? Let's be honest. You get a window here to send price packing. And that's part of the narrative. You either need like, woo, we hit 6,450 or 6,500. Let's pack it up, boys. What are you rolling to now? Puts. Oh, okay. Or you need some kind of a melange of failures to get higher, of loss of the buy point, right? Price will do it. Events will do it. Nice little mix of all this, right? Bad data will help. You start writing that bear narrative. You start getting the proof of it. You start really scaring these people that roll their positions higher and higher and higher and higher. Seasonality becomes more important. Everyone gets scared. You go from hedging to buying puts and more puts and selling. And the cacophony grows and grows and grows, and eventually that sentiment shift takes us there. So this conversation I was having yesterday, I was like, I don't know, man. I was like, I can't tell you the top is in. I mean, it looks like it's in, but it's not. The mechanics don't say it's in. Price doesn't say it's in. Trend doesn't say it's in just yet. And I understand your sentiment. Personally, I have a huge fucking hedge in the market, a big one. I would love for it to print. I put my hedge out to November because I don't fucking trust this market. I don't trust it. Irrational, stay irrational longer than you can stay liquid. You ever hear that before? And nothing's pointing towards it yet. Just pure trend, pure price action. We're not there yet. And you know what my friend's response was? This guy's been in market forever. He goes, it's going to be one of those things, isn't it? And I go, maybe. He's like, we're going to need 2 red bars, aren't we? I'm like, yes. Yes, we are. You know, you just wake up on like a, let's say, like on a high on a Friday. You come back on a Monday expecting a down move like this past week. You know, you come in a Monday from Friday. You don't walk in on Monday and say we're buying calls at 6:40.28. Nobody in their right mind was buying calls at 6:40.28 on Monday morning. There's nobody on the street that'll chase price on a Monday morning on an up green bar like a gap up on Monday. They're patient. We'll just wait down here and we'll buy the dip lower. Where the island is, where all the buyers are, like right here. And that's what they did. They bought it again and again and again all week. And they've been doing this all week long. They did it on Friday. They did it on Monday. We're only on Wednesday. They did it on Tuesday at yesterday's close again. The second half of yesterday was accumulation. Again. Couldn't break the island. I call them whore masters. I call these guys right here whore masters. These guys are the whore masters right here. And they're just buying. Anything you can buy. Buy it all. And see them down here. Just buy. You need to get rid of these people right here. And you need to convincingly break trend. And we're on the 30th of July. We're 1 day away. If you're a bear or a seller, you've got until the 5th. What do we got until? When's Friday of next week? You've got until the 8th. If you can't break trend by the 8th, do you know where we go? We go up. We go up until like August 31st. I can show you years where we go up into late August, late September. There are years where we've gone vertical, straight up into October 31st. I kid you not. Not October. September 31st, I think, is the latest I've seen. But that's still 2 months away. I want to ask you that. If you're watching this show right now, I don't think we go up until September, last day of September, but let me ask you, what in your positioning would happen if we went up for 2 months? So you can't say the top's in just yet. We haven't broken trend. We have not broken the island of buyers. We have not shaken sentiment yet. This morning, I just saw extreme greed is out there. I see the options market. They're reining it in, but they're still looking for a print right now. So the conversation we had yesterday was good old-fashioned red bar. So what you're looking for, I'm going to show you what you'd be looking for. You come in here on this Friday, right? They gap us up. And what you're looking for is like, hey, nobody's going to buy this. We already know that, right? You see, you come into like Tuesday, then you come into Wednesday low. Right? So here's Monday, here's Tuesday. And what you would expect if you can't do it with news, with sentiment, with the option markets, with the layout of everything, normally what you do is, and me and this guy were having this conversation last night, you come in on the day when it is time to buy the dip, when you're like, we buy the dip on turnaround Tuesday or what the fuck Wednesday, and that's when they red bar you. Straight down. That's the first sign. Now that dip will be bought automatically because these fucking bulls don't care. But a good old-fashioned red bar. For what reason? None. We're selling. We're taking profit. We're leaving. We're done here. Literally, real money selling. So you come into your like Monday low, Tuesday low, and then what would you get on a Wednesday? Big fat red candle right here. And you would expect these buyers to step back in. That's what they've been trained to do. Buy the fucking dip. So they're going to attempt to buy the dip right here. And they're not going to know any better. They're going to fail in here. And then once they get the second candle, bam, they know they're fucked. And they're way down here, and they're like, oh, God, there's no way. We had this candle that was weak over here. We had the big drop candle over here. We have the bulls pooped out and tired. And then we get the big drop right here. There's no way we're coming back. Where can I get some puts? And all of a sudden, that sentiment shifts. All news now looks like bad news. So sometimes it does come down to that. Sometimes you don't need an event. Sometimes you don't need anything. You ever notice that? You just walking through the market one day and you're just down 30 points and it sticks. Or you're down 30 points and it doesn't stick. But when it sticks, and then you're like, oh, shit, here we go. The roll is happening. Well, that's when it matters. We're not there yet. Either from sentiment, we're kind of getting there with the option market. We're starting to flatten out in expectations. Kind of getting there. We're topping. Is the top in? I can't tell you that it is. Not with certainty. And not with with an edge. We have not broken trend yet. We have not fucking gotten those two red bars yet. So it's like all these things have not happened yet. And if I was a bear this morning, I'd be upset. I'm not talking about someone hedging. I'm talking about the bears that hide in with you hedging. Oh, they're hedging. We're gonna start rolling here. Is there a bear hedging here? No, not us. We're not doing that. Are you in fucking like puts right now that are gonna expire on Friday? No, I would never do that. Have you been reading the quarterly refunding announcement that's gonna do it? Yes. No, definitely not. They're just lying to you. But I want you to know, more importantly, that calling a top does not help. It's always better for you to have that proof. Hey, we're breaking trend. We're rejecting the hourly trigger. We're starting to make new lows. And how much of it do you need? Do you need the bottom tick on a reversal to the upside? Fuck no. The only people doing that are fucking losers. I'll be honest with you. They fucking lose. The only people top ticking are losers too on a reversal change to the downside. You just want to be there and know that it's happening. You can hedge, but a hedge isn't a trade. A hedge is like insurance. If you buy a fucking house, you expect to put insurance on the house. Do you buy the insurance on the house and say, I'm going to make some money off this fucking thing? I'm paying in my insurance every year. It costs me $300, but, in the next 5 to 10 years, I'm hoping to make a cool $1 million off that. You're out of your fucking mind. You're protecting your investment with a hedge. It costs money. You're not expecting to get rich off a hedge. When you're looking for the roll, you're looking for certain things to happen. You've got one part of it right now. You got two. The first part you have is the option landscape is slowly changing. The second thing on your side is seasonally we're getting a little long in the tooth. Starting to. It's not a fang, but it's starting to get a little long, right? And you got one more thing, a window. You got a window between now and let's call it next Friday to get this party started. That's it. That's all you got right now. You don't fucking have the roll. And you have not made progress to the downside since Vixpiration and OpEx. And there has not been real money selling. And there has not been a full switch to bear with the option market. So we're kind of stuck here in the middle together. And the moment we do roll, we'll get bearish. We don't need the full 5. Hell, a hedge will cover it. Hedging's cheap. It's dirt cheap. You can get like 9-1 right now on a hedge. To 590, it's even better. 600, really good. So you just sit there with your hedge, put some time. You can buy time right now. And you can take it all the way down to 5,900, 50 or 6,000, and you're easy Stevie. It's an easy trade. But to be calling for that doom is unauthentic. And it actually fucks up a lot of traders. If you look at Friday close into Monday open to Tuesday close to today, you're literally trading like we're selling the open, we're buying the close. We're selling the open, we're buying the close. And if you fuck that up, you're getting eaten alive as a bear right now. I know you are. I watch. You're getting annihilated. You're not getting the print that you want. I know the print that you want. The print that you want is fucking 1-2% down in a day, and then you want follow through with 3-4-5%. I know. But you haven't got that, have you? That has not happened yet. So you got to look for it. And you got to wait for it. You can hedge, but you can't be all, you can sell the opens and stuff, but you can't be out there like, we're going to crash tomorrow. It's done. It hasn't happened. When it does happen, I'll be with you on that trade. But until that happens, until we break this shit here, none of this says down just yet. Just yet. Will it happen soon? Yes. I think. I hope. Eventually. But I think that this is the cause of a lot of angst. It's, you really need these buyers to go away. You need a reason for them to go away. And this morning did not help, did it? Quarterly refunding announcement didn't help. GDP, that was a mess for sellers, wasn't it? Expectations 2.3 came out at 3. At 3. And what do we have today? I did write this in here. I wrote Jolts Bear. You can see it right there. I wrote that in there last week. Jolts Bear. You got some PCE that's possibly bear here. This has been a source of a lot of inflation. Services inflation has been wild. Durable goods inflation's been kind of a hidden. It's there. It's just spread out. And there's also some employment stuff coming out on Friday that could be important as well. So these things can become more bearish as we head over here, but I want you to think about this roll. I want you to think about like, hey, if I'm a bear, I need to see like some bad news. I need some more bad news. And today there's not much left. It goes against you today. Why does it go against you today? Because we have a benign FOMC meeting. We have a massive amount of reports today. Massive. And those analysts are typically wrong. In a bad way for bears. They're normally under analyzing or lower expectations than will likely report. About 80% of companies today, or this season in particular, about 80 to, I think it's 83 or 87%, somewhere more in line with that, where they're getting beats. So it's a pretty significant day for tech earnings. We have one more next week. We have a huge 2 days next week. We have like 2 days with like 300, 400, 500 reports, all in a concentration on Tuesday, Wednesday. So it's just not happening yet. I wish it was. If you're a bear out there, I've been shit talking bears all week long because they've been wanting this to begin. And I can see and know why they want this to begin. We're at the top of the key and trend. They want to see it come down, and then break trend and break these bulls. And that has not happened. Price is not there. That's the reality. So we wait and see. We got 2 more days. We got the 30th today. We got the 31st tomorrow. The 1st is on Friday. Hopefully, these bulls get the print that they want, and you get the bad news to get us over and under. We can start talking about this downside move. If the bears can't get this and you don't get that bad data, you get any kind of reinvigoration of more upside, you get rolling of calls, all of that stuff happening, you got to begin to look higher again. And that's really what this conversation is about, is that you need to know if we're going to go higher in August, and you really need to fucking know if we're going to roll. And I think there's some disingenuous out there. Hey, the roll started, the top is in. I've gotten blown out here. Not in this time of the year, but I got blown out in something like this in like might have been in October. I thought it was a February, though. It was like February, March, something there. We'd already gone down, I guess. And they were like, we're going to make another leg down here. And we didn't. We started getting back in trend. I think trend was like here. We like came down for our seasonal weakness. And they were like, we're getting another leg right here. And we didn't. We actually started coming back up in a trend. And I was like, oh shit, what's going on? And they're like, no, don't worry, it's going to reject and go down. And we literally went back in trend and up and to the right. And it was a disaster. It was a disaster. So I would say to you that before you move from a hedge to bear, unless you're doing intraday stuff, but like your thesis, hey, that was the top. Hey, we're rolling. This is it. It's done. I think eventually you're right, but I think it's easy to get annihilated in there. So I want to ask you, is your positioning right now, if we were to go up for the next month, would you be okay? If we went up for the next month or the next 2 months, would you be okay? Could you adjust? Could you roll? Could you counter trade? Is your hedge out far enough? I'm not saying we're going there. I'm just wondering. Could you adjust? I think you should have that in your plan. Not that you think that's going to happen, but that you should at least say to yourself, look in the mirror and say, okay, if we do stay on trend higher, and I hate this fucking guy, Jim James, but if we do, I promise myself I'm not going to blow up my entire year on this. Right? If you're a bull, long is the way right now. But if we begin to lose, these buyers start disappearing. You go up there and hit that, and you start to see this same kind of price action, right? You start to see the bam, bam, bam. Even if this is higher, and they red bar your ass, you better be able to shift too. You know, just like fast break. If you ever played fast break basketball, high school, college basketball, fast moving game, right? You have to be able to shift, right? You got to be able to transition immediately, not argue with the refs, not fucking around, giving the middle finger to your opponent, not crying in the corner of the basketball court. You got to shift fast. And I think that somewhat applies to bears here, maybe even more importantly than bulls. I think the bulls are kind of ready for it, and the bulls are fine with it. They see it, but they don't see it like a bear sees it. The bulls are like, I just need to see that roll, bro. And I think the bears are like, it's in, top's in, that's it, it's done. We're going down. And that didn't happen. It didn't happen this week. It didn't happen here yesterday. It didn't get low enough. You didn't even break down enough to get the new low. It didn't happen this morning either, did it? You see these wicks right here? These are buyers. They're buying, 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 buying. You can see the wicks right here. They're just buying. So we kind of need to see that price action. We're not seeing it on a base case right now. It may just come down to a couple red candles. I kid you not. It may just come down to a couple red candles. Like, the setup is usually a nice high. If you can't get the news and the data or the events or whatever, it's normally like nice high, you sell out. Monday, Tuesday, looking for buy a dip, and they literally red candle you in that second or third day. That Tuesday, if it's a low, or that Wednesday, they red candle your ass down. You get another red candle, you're off and running to the downside. Now we're going to look here at, oh, sorry about that. Let's get rid of that. Sorry, this is all previous history stuff. We have something else going on in here too. We have this traditional bull flag, right? We know that traditional charting doesn't work. We know that we're looking for a failure, right? Down, down, up, down, and then a failure, right? Or a failure here. Either or. We definitely don't want to see up, down, uh-oh, no new low. We don't want to see that. We wanted to see this, didn't we? Hell, we didn't want to see that either, did we? We wanted to see the break, the rejection. That has not happened yet, has it? If the way is not lower, which way are we going? If you can't get the low, if you're down here and you're being told the way is down and breaking, and you can't get the new low, you can't get the break of trend, you can't get the new low, which way are we going? Probably higher. Higher at least until these guys. Higher at least to right there, right? Minimum. If not a breakout to where the real supply is up there. And you're looking for these events and they're not happening, are they? So for right now, for today into this Fed meeting, this is supposed to be a benign Fed meeting. Last time we had, there's arguments that there'll be two dissenters today. Last time we had two dissenters, market ramped for 3 days. Rampo-rama. Do you know why it ramped? Because the fucking bond market does not like dissent. They like the Fed to stay the course. For those of you out there calling for rate cuts right now, I assure you, you do not know what you're talking about. If you look at the long end and the 30-year, the bond market is screaming to not cut short-term rates. You're telling us, do not cut rates just yet. Soon, but not just yet. And even in today, if you see dissent today and you see that we don't cut rates, it shows confidence to the bond markets that we are staying the course. Because of two reasons. We still have no fucking deals. We don't. Black and white. We do not have deals. We're closer, but still no deals. Inflation has reared its ugly head. Greedflation in services. We all feel it. There's also some durable good inflation that's spread out, insidious and quiet. Surge pricing. Your bar of soap is only $1. Well, now it's $3. No, it's $1. No, it's $3. Nope, $2.50. $3.50? So there's some hidden inflation too, even in durable goods. But then we have one more nasty thing. We have seasonality in oil. We also have cyclical and trend-based inflation coming to bear. If you watch a chart of natural inflation, the natural cycle inflation, we're bottoming right now. Smarter people are aware of this. So maybe you get a cut 25 BPS, you get 50, make you happy or something, but to say we're going to 1 is insane. We likely got to go through inflation, right? We're going to go through a bout of it, no matter what they do. When Jerome leaves, you're likely going to be at a place where we can cut a lot, where that new Fed chair can come in and say, we're going to make a bunch of cuts. But the market's likely going to be on fire at that point, too. And inflation will be raging at that point, too. So for right now, if you're a bull, I'm telling you, believe me, you do not want any substantial cuts. That means the Fed is doing their job. And the bond market is not going to freak the fuck out. You start cutting rapidly rates right now, that 30-year is going to fucking moon. What about the realtors? Oh, they're fucked. They have no idea that's why they're a realtor. They don't know what the fuck they're talking about. You really, truly want the Fed to stay the course right now. Maybe throw you 25 BPS as a carrot. You could do it 25 BPS if you rationalized it by saying that the trade deals are almost done. A little bit of easing can make the market go up, like 25 here and there. But rapid cuts are always saved for poor economic and market and business cycle conditions. Like rapidly cutting, that's what that's saved for. Historically, when the bulls tell you that cuts are good for the market, or there are examples of them, they're typically slow, they're slow and deliberate. Haven't over-tightened, haven't under-tightened. You'll sometimes see that, but we're not there yet. So today, the expectation for today is that this is a benign meeting. And regardless of dissent, or the bond market wants to see Jerome Powell and the rest of the governors say, fuck off. No cuts, if anything, too, I'll be honest with you. We're likely closer, I'm going to say it again, you're not going to believe this. We're probably closer to a hike than a cut. If I had to guess like where we are in the middle, I can see the 25 BPS cut to appease the potential trade deals we're going to get. But then on the other side of it, I'm like, we're coming into inflation. I would want to hold and maybe even raise rates to quell some demand. Now, that sounds crazy to you. That's what the data says. Now, in this chart right here for today, when you see these dotted lines, these are only for accumulation. If we come down here, you're a buyer. But the way is higher. And the way is not down and then up. It's up. Price target remains 638.60 and then even higher. 639.26 and then 642.50. That's right. Let me ask you that question. Are you ready for that? Unless we break that support that I showed you earlier, the way is higher. 642.50. Maybe even higher than that. I've got higher numbers. Now, there's something else I want to show you here, too. This also takes into account, that boom, super high, and then this actually takes into account some kind of a unclench next week into the early part of August. Well, there's your daily trigger right there. I don't think that you blast through this and never come back immediately, but I think you have the potential. Hit that high, come down here, and then some kind of a failure in like the 18th or something. Then we start making our way down into middle of September, end of September. 162 trading days. Look it on a calendar. 162 trading days. Somewhere in there, some kind of a bottom. That's where you come in to get your 600, whatever it is down here you're looking for. Currently, we're at 592 as a target. You throw in a few more weeks and we're even higher. 600. Right? This is September 15. I think we can break through this, close this gap over here, but you can see here's mid-September. Fuck around down here. This is 604, 608, 610. I'd really like to hit the 600 or even the 592, but there's no guarantee. You rein in your expectations and you take more money if you can get down there. But until we lose that support, I'm telling you about that island in the sky we have going on here. It's like right in here. So we lose this island in the sky, way is higher. If we hit that 64.50, I don't expect more rolling higher. 64.20 maybe. And we start rolling our way to the downside. Or we lose support and we'll call it, nope, we're not going up there. We're going to start heading to the downside to 600. It's fairly easy. Sorry about that. Let's go down here and take a peek. See where we're at here. Trading a high this morning of 636.82. We know, give me like 2 minutes here. Give me like just 2 minutes. I'm going to take a quick break, and then I'm going to talk to you about what to expect for the rest of today. Give me like just 2 seconds here. I've got my oldest daughter has just come to me, and she needs me. Just give me 1 quick second here. Kids need money. Check. I just read someone wrote National Saboteur. I don't know what you're talking about, but I like it. Whoever that is, National Saboteur. So, we have a bunch of reports after the bell. We have FOMC today. I don't expect any kind of rate cuts, any kind of rate hike. The expectations on the print this week is 1% move. A 1%. There's no expectation of a lower print. Volatility expected, right? Season of volatility. It's going the wrong way currently. If you get a rate hike, I guess the volatility can kick back up, but we start smashing or killing volatility, don't we, until the next round, right? But we've got expectation. I mean, we had huge expectations of volatility this week that has not happened. We have not broken support. That's why you're not seeing volatility ramp-o-rama yet. We do have some expectations of volatility for just seasonality that'll pick up and pick up and pick up as time passes. We haven't had realized volatility at this point, have we? So we're looking for that today. We're looking for that Thursday, Friday, and even next week to continue to the upside. For today, I'm not expecting much out of the FOMC nor the Fed. There's an argument out there that there's dissent. We're going to talk about that this morning. I'm going to give you a reaction function, too, for NFP on Friday. I'm going to also talk to you about some of the earnings that are coming out after the bell today. So you're going to get stuff on earnings today. You're going to get stuff on what to expect with the Fed today. And I want you to know that there's not a lot of movement expected yet this week. 1% move. That's not that big. And there's one last thing I want to tell you. That is that this is the end of the month. Today is July 30th. Tomorrow is the 31st. If you're expecting some kind of like a 5% drop today, tomorrow, I doubt it. I doubt it's that big. Why? The most profitable months of the year, one of them happens to be July. We're doing catch up this year. Not we, but the street is. They want that nice, beautiful print for the end of the month. You can have half your August for doom. You can have full month of September for doom, but they're going to close this month out in the green. That would be the expectation. And as soon as we're done with all that bullshit, right, into the end of this month, you can have your way with the market. You know what I mean? You can go out there and be like, okay, August is supposed to be, Cap said it's not supposed to be anywhere near as good as July. I would expect that. Your end of the month print shouldn't be good. Your September print should be awful. But right now, you got like 2 days, 3 days. You're going to let them report. You're also going to get some more reports next week, middle of the week. That could be the set piece for the roll to the downside. Now, as for today for FOMC, we're priced in for the day. We're priced in. So I'm going to show you right now some targets on the day. Normally in the morning, you'll see a lot of traditional setups, easy trading, till about 11 to 1 o'clock in the afternoon, right? They'll start to hedge the event. You'll get a downside move. You'll get an upside move. You also have to be aware that dealers are going to fail targets higher and lower. They'll fail both sides to not give you full prints. They have overpriced the stock market today, as expected. Yesterday, they started doing it yesterday. They started making calls and puts more expensive as the week. They're setting this up, this event, right? So you're overpaying for your positions for today. And then they're going to take all their money away from you. They're going to vacuum up and clean up today, just like a cleaning crew is going to come in at the end of the day. And they'll be like, okay, wrap it up. Thank you very much for playing. Thank you for donating all your money today. And now we're going to make our real moves tomorrow. Where are we headed from here? That's how it'll go. So we're going to take a quick peek at some inline expectations, or what's the market prepared for today. And we're going to take a peek at where those inflection points are. So if you're a trader and you're like, I'm trading 0-to-8 puts and 0-to-8 calls, or I've got a straddle or a strangle, whatever it is you're doing, I'm just short this market. I don't care whatever it is. We're going to start looking for some price targets for you at 2 p.m. and then for the presser at 2:30, some upside and downside targets. And we'll set those up for you right now. We'll start the day with that. So it's 11 o'clock right now. So in the next 2 hours, we'll get into that. And then I want you to think about the reports that come out after the bell. And we'll start talking about some of those major reports, those big tech reports that are after the bell, maybe a couple others if we have time. And then we'll look towards tomorrow, next day, and see what we're looking for. If you want to know pretty much where. Let's go see if we can take a peek at Gamma this morning. Come over here and take a peek here. We'll take a look at some of the newer numbers here. Excuse me. Still have horrible throat issues right now. So here's your Gamma picture. We're going to go to an hour here. Get a few things to be looking at. Here's the local call wall right now, 64.50. This is the local top in here. Still. Just so you can see where it's at, it's right here. Local top, 60.50. I don't think we trade this. I don't think we roll higher. I don't. Maybe we will. If we begin to hold 6,400 and roll calls to 6,600, I'll let you know. But we're not there yet. There are a few people rolling their calls higher, but it's not significant enough. We're also holding up right now on all of this island. I call it Poop Island. I think David AMS calls it Island Boy. He has his own terminology for it. Everybody's got their own terminology for this stuff, but I want you to see, let's get rid of this right now. Get rid of this right now. I want you to see, though, right here, that until we lose this, the way is higher. Kind of see that right there. You can also see it in here. This is important right here. This is the up. No, you can't come up here. No, we're going up there. No, we're not going up there. Yes, we are going up there. No, we're not going up there. We make the break up here, right? We got the high here, and we still have buyers coming in. Still have buyers coming in. So for right now, the way is higher. Now, if we begin to lose this support in here, there could be an argument made that 6,300 matters, but I'll be honest with you. I don't think this is valid anymore because of the option market changing. I don't think that's valid either. We just check the flip. Flip's at 62.75. It's a little bit lower. But we'll call this the gamma flip right in here. It's more in this zone right here. There's not a hell of a lot holding us up over 63.50 either. Well, no, we'll change this. This is this is green. Make this the gamma flip, but I want you to know something. 63.50. If you want to do this at home, you can. But what I want you to know is this area right here. This is an air pocket. I wrote that horrible. That looks terrible. Sorry, I'm using my cursor or my cursor. There's a giant air pocket here. So I want you to think about what's important here. If you're a bull or a bear, what's important here? I want to say this 63.53 is it, but I'll be honest with you. Seeing this price action right here, I mean, you could potentially make one more low. Close this gap over here. You can kind of see that right there, right? One more low. And still stay in the island. But I want you to know that if you see us, or if you see price, what there? If you see price come down here, right? Still in that bull flag. And you see that break of that 63.50. Any of that kind of price action, the run is over. If you're a bear or if you're a bull, wrap it up. There's a huge drop. Show it over here. There it is right there. You drop down here, right? Or you break trend yesterday. Down here. Any of that kind of price action. Mark down 63.50 on your wall at home or whatever. We begin breaking this right here, and it's literally a straight drop down. Now, this is neutralish in here. 6,300 to 6,275 is a little bit more neutral, even though it's positive gamma. It really isn't. There ain't shit down here. So you start blasting down here. You do a halfback trade, and before you know it, we're running to the downside. So just be conscious of, in particular, start to become conscious of this 6,350. This 6,375 does matter too, but and I think it matters more because of this action right here. But this has been used for buying still. You can see it. You can see the wick right here, wick right here, wick right here, wick right here, wick right here. All these buyers are just sitting down here. And every time we get down there, they're just buying. So we need to see these guys disappear. And more importantly, disappear from down here. Only because of this gap that's left behind right here. There's a tiny little bit of a gap right here. I can't say that that is not a part of the island. In worst case scenario for like a stretch in price, 6,350 is kind of my like no-go zone. You get down to 6,350 on SPX and you start making new lows, and I'm going to be like, uh-oh, we're fucked. Party time over for the bulls. We're never coming back. That's it. We're done. So SPX Gamma, if you want to know what it is, there it is. I'll put it down one more time for you. Hold on here. There's your elevator shaft. Yep. 6285. About there, somewhere in there. About there. If you want to see that right there, you can snip that, keep it at your house or whatever. And there is your gamma for today. And it should begin to deteriorate as we get into the new month. There's an expectation that once we're after the beginning of the month, there's the first right here. Gamma market can unwind. We can get down there. Bam, bam. See you later. Suck back up. About the 18th or so, and then back to the downside. Next up, we're going to do expectations for today on intraday for FOMC. Trigger screen. You can see it a little bit more clearly here. Buyers, 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 buyers. Remember that we have month end. We're going to put a new monthly candle in here. For now, it's still lower. But your monthly candle will move higher. It'll move right here. When we get into tomorrow, close of tomorrow. Here's your weekly candle here. You want to see where we close tomorrow, or Friday, excuse me, not tomorrow, but Friday. You want to see what the closing print is. And I want to bring you back here to show you one other thing here. I want you to think about something here. I want you to think closely here. This is your weekly candle. This will turn into a month. But I want you to visualize something here with me, okay? I want you to think forward. I want you to think about August, September, October, and November. I want you to think about this push higher right here. I want you to think on a monthly basis. We go up, right? We get told no. Well, it's actually like here, no, then here, then up, then no, then yes, then no, then us, then no. March, April. Right? This is the down move in March, April. And then I want you to think about when we came back up here, right here, right? We erased a little bit of this candle in this month right here, didn't we? But not all of it. So the way was higher. We went up, right? And now we're in July. So big June candle, big June print. We're now in July right here. I want you to think about whatever the pullback is in August, in September, in October, November. I don't know, the market's over, whatever. We're going to crash everything. Think about what your outlook is. That's not my outlook, but I'm sure for some of you it is. I want you to think about this closing candle here for the month. This candle is important for the next month, for August, and for September and October. I want you to think about, do we start rolling now? Do we go up into the end of the month? Where do we start the new month candle? And I want you to think about that because if you look closely here, right around here, see it right in here? I want you to think about this number, right? Like 620, 617. I want you to think about if we begin to roll in next month. Sorry about that. I want you to think about 20% of that candle right there. Like we start rolling down into, let's say, August. Right? We hit this. You want to see if we hit 620 or even break through to 617. If you take this whole candle here, we will go down here and eat some of this candle. There's your 610, 608. I want you to think about this candle too. This candle can go down to about 20% of its whole body. So right about here. Right about there. So if you have some kind of a retracement, some kind of a corrective move, some kind of seasonal bearishness, right? Oh, we tried. Here's your big monthly wick. Right, oh yeah, we got a wick. Oh, it's lower. Right, oh, we took out more than 20%, bro. We took it all the way down here, bro. I want you to think about that. That will imply a bigger move down here in October, or September, excuse me. You can go all the way down here to 592 and still be fine. I don't know that we're going down to 592, but I'm just letting you know that you can go this deep and literally still be in a bull market and literally still be on trend to the upside and literally still moon into the end of the year. And you get your nice 1-2 months in here. You know, you get August, kind of weak, not great. You know, it's kind of like, you know, it's kind of crappy. And you get your big payout here in September. Maybe you get a little bit of, you know, October in here, some kind of crap, some wicks down here. In October, November. Start making our way up. December. Volatility. Back down. Halfway. Wham up in the end of the year. February, January, February, or whatever. I want you to think about these candles on a monthly basis. More importantly, for these next 2 months. Now, this is a weekly right now. But it'll turn into a monthly candle. We're going to focus on this one right here for now. You can see the island right here on a weekly basis. There's 1, there's 2, there's 3, there's 4. Did you know that bulls are alive? Right about there. Bulls are alive above 629.45, roughly right there. In this zone, they're still alive. The fucking buyers still alive. Not alive under here. Lose 617.15. You don't even need to lose that. You can just lose 620. And it's good night, door closed, bulls, bye-bye, come back later. I think it's higher, but personally, I think we're done at the 629.45, personally. They're getting too close. I don't think they're going to allow you much room for error. So there's a weekly. And this is what's most important here. For intraday, day trading type stuff, you got a daily here. You got a daily here. And you got a daily right here. And you got another one. We got to wipe all these out. I can't wait for the roll. I really can't. Oh, nope, wrong one. It's just like juicy, isn't it? Look at it. What happens if we don't break this week below 634.51? This becomes a weekly candle right here, right? Let's look at the last week. This is a daily candle. This is Thursday. Here's Thursday of last week, Friday, Monday, Tuesday, Wednesday. And Bear's telling me we're done. I'm like, I don't know, man. I want to see, like, you see, I don't see us done yet. I mean, I see a bunch of red candles, but we haven't had any red candles. We've been sitting up here, just teeing off, right? Ping, 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 ping. You're a bear, you really need to get rid of this. Let's look at a 4-hour basis. This is good to see right here. I like this. Haven't seen an upside 4-hour candle in some time. That's good to see. Make that yellow. Starting to see where our range is now, aren't we? There we go. Make this one red for now. This one yellow. We're in business. We got a range. Sure, intraday range right in here. Now we're going to look at where are the pivot points. Pivot points at 63609. S1 much lower, 63350. There's your daily candle here, daily candle there. S4, S5, all the way down here. Kind of know that the bulls need to hold. Last known buyers right down here. You could also say that they're over here. You're going to expect them to be higher. Right? That's where they were before. That's where they are there. We're going to just write it right here. Last known buyers, like real support somewhere in here. This is where they are over here. You can see them both there. There. They stepped in here yesterday. Bought here. Bought here. Expecting the buy right there. On a daily basis, velocity peaking on daily. Bullish on a weekly basis. Strong weekly finishes. A little long in the tooth on higher frames, but still not topping yet. This we could easily accommodate a correction in the fall and still head higher for a blow off end of year top, still available there. On a 30-minute basis, this is your intraday trading type stuff. You're getting a little long in the tooth in the daily, almost time to wrap it up. This is not good for bears. Not necessarily good or bad, but I don't like seeing like a bottom in hourly velocity. I don't like seeing higher lows in hourly velocity. I would like to see this like go up and mark a top in the markets and a top in daily. So bull's still alive right now. I don't like this. I wish this was, if I was a bear, I wish that we were like on a high, like right here, and a high over here, and the market being on a high. I would like that personally, but we're still making higher daily closes, even on this high, higher daily closes, higher daily closes. Still accumulation mode on a daily basis, still accumulation on a weekly basis. You really want to see like a bad week, red days, all that kind of stuff. We're not really seeing that at this moment. So bull's still alive. Price action says it. Trend says it. Makes sense. Right about there. I'm just looking at where these buyers are over here. Go back to a daily candle. That's that big candle up in this big. See this one right here? This is kind of where we need to be, right in here. I don't want to see this candle. I want to see this on a daily basis. I want to see that candle right there. See, it's down about 80%. That's okay. Means the buyers are still here. We don't want to lose this one right here. If we lose this one right here, you're going to go back down, take that one out, take this one out, take this one out. That's your first stop. You blast down to that one right there. And so right here. Yep, right on there. Bull case dead. I think it's higher, but bull case is, I don't know why that's happening like that. Maybe because I'm on a daily basis. I think it's even higher than that. You could argue that it's right there. So I've got this blue here as just an accumulation zone right here. You can see it right there. It's Thursday. Wednesday. That's worst case scenario. I don't know if that's vertical. Yeah, over the weekend print. I think it's Friday print, but there's Friday. There's Monday. Where's Monday? There we go. It's better. Here we go. Ready? Hedge comes on the market on a high all the way down here. We also have Euro close. We also know about 10 a.m. in the morning, 12 p.m. in the afternoon, right? So now we're going to put some time in here. There's 11 o'clock. There's 11:30. What happens at 12? Anyone out there know? We got our second wave of volume, right? You know that everyone's trading today with their own virtual servers using AI, and they're their own mini high-frequency trading companies, aren't they? We know that volume comes in at 10 a.m., and we also know that volume comes in at 12 p.m. Normally lasts at 10 a.m., it lasts till about 11:30. Then we come in at 12 and find out the next round of buying and selling. That normally lasts till 1:30, 2 p.m. We get the next round of VIX fuckery at 2, right? Then we go into the close today. Now, in today's case, we have the FOMC at 2 p.m. and 2:30. So we get parked here sideways awaiting that announcement, right? We await the rate decision. We also today await the press conference. We also know there's going to be some pertinent questions, right? Geared around 2 or 3 things. The first thing that you should be looking for is a discussion from any dissent from governors inside of either the press release or even the voting today. The second thing you want to be looking for is any kind of discussion from the Fed in terms of cuts or hikes or where the policy is from the White House. Now I'm going to read a few things for you today from my expectations from the Fed. I want you to know that the Fed is not restrictive. That's a shocker, isn't it? Like zero rates, wanting negative rates. The Fed is literally not restrictive. How can you tell that? Do you know? Let me ask you a serious question. Is services inflation rising? It's a simple question. It's going up, right? That would mean that the Fed is not overly restrictive, are they? If they were, services inflation would be on the way down. We would also be in what? Stagflation, wouldn't we? Do you see stagflation anywhere? I don't. I see refusal to accept prices. That's all I see. People are still willing to pay prices. They're deciding where they want to spend prices, but is the Fed overly restrictive? I don't see it anywhere. Where's the price of the stock market today? Trading 636. We're a couple dollars, $4, $3.50 from all-time highs. $3.50 from all-time highs. Is the Fed's policy restrictive? We have inflation ramping. Would inflation be ramping if the Fed's policy was restrictive? The answer is no. We also know that financial conditions are loose. We also know that there's mania. Last 2-3 weeks, what are we doing? We're ripping up meme stocks, right? Retail army is out in force. Did you know in Q1, financial services companies, banks, had one of their worst quarters on record? No fees. Retailers were gone. They're like, we're going to sit out. Captain Jim James told me to wait. So you did. But then the retail army is out, aren't they? They're pumping up every stock imaginable, aren't they? That's not a sign of recession, is it? Do you guys see any recession out there? I don't see it. See any stagflation? I don't see it. That means there's money in the system. It means we're not restrictive enough. Think about that. So we're coming into today. Is Fed policy restrictive? The answer is no. There are exceptions to this stuff. We know that there are like other issues in the economy. We know the housing market looks like shit, but it's not that bad. It's not like the crisis. The housing crisis, is it? No. Commercial real estate really looks bad, doesn't it? That looks horrible, right? And we want the longer end to come down, right? That's not through cuts, is it? The longer end rates will rise, right? When did we see that last? The last cut that we did. Go look back. We cut rates and the 30-year ramped. So at today's press conference, right, you're going to expect Jerome Powell, right, to point out again that the policy rate is either, mild, somewhat restrictive, but it's not overly restrictive. And no, the Fed is not going to tell you today that they over-tightened. They can point you towards data right now that speaks clearly that we're not in stagflation, that we're at all-time highs, that the meme kids are out and partying, that inflation's poking its head up. And it's been doing that, hasn't it? Since when? Since we got Trump tariff 2.0. Well, I got to go order, I'm going to go fly 1 million phones over on a plane. I got to raise the price of beer. How much? 50%. What are you going to do next month? Another 50. Then another 50. 25, 25, 25. We'll do it for the next 6-7 months. When did that start? November, December, January, February, March, April, May, June, July. 9 months ago. 9 months to spread it out, the greed. So they're going to tell you today that it's restrictive, but not where it could be restrictive. Likely. They're also going to tell you that the midpoint of the Fed policy rate is still substantially higher than the inflation rates. Overall CPI inflation did accelerate to 2.7% in inflation services, especially non-housing services and services that matter because they're 2/3 of consumer spending. You only buy a couch so many times, right? So you're feeling it out there, aren't you? You're feeling inflation. 2/3 of your money is experiencing inflation right now. Let me ask you a show of hands. Tell me in the comments. Do you feel the inflation? I feel it. 2/3 of the money that you spend is an increased inflation. Even if you have money, you're still feeling it. That same guy I spoke to yesterday, I had this conversation on this show a few weeks ago, and he went on vacation last week, and he came back from his vacation. He's like, they're out of their fucking minds. I was like, bro, I go out to dinner right now. It's fucking $2, $3, $4, $5, $6, $7, $800,000. Bring the wife, bring the kids, bring some friends, bring a family member. It ain't cheap. I got to pay for parking. I got to pay for a driver. I got to pay for this. I got to pay for that. So we're going to go to an event on top of it all. Thousands of dollars later. It's not even quality. I go to buy chicken in the grocery store. It tastes like fucking sawdust. I look at the breast and I go, this is obscenely huge. It's got tear marks in the muscle. It tastes like wood. It's because they're growing too fast and ripping their muscles apart. And I'm paying top fucking dollar for it. Matter of fact, recently, I can't even find a fucking... I literally cannot find an organic free-range Amish chicken whole with small breasts on it. I used to be able to sneak around this and buy whole chickens, and I'd cut off the small breasts. Gorgeous. Same kind of breast you get in a quality restaurant. You can just snip and cut off beautiful little breast that tastes like chicken. Can't do that anymore, can you? You got people out there asking for steaks, $30 for a New York strip, $20 for a New York strip. Sometimes you can still get them for $12. Go to like Aldi or something. They're still there. So you got to like seek it out and find it. But we all know that inflation is everywhere. Don't tell me you can't feel it. I can feel it. You can feel it. It's everywhere. My money, I think, is worth a third less from November. A third. Before November, probably 50% less. Now, wages have kept up. If you check wage growth, it's there. It's matching. It's good. That's actually not bad. It's not horrible. We're not too much inflation yet. But we're not restrictive either, are we? The Fed's policy rates being substantially higher than any of the inflation rates in theory means that these policy rates turn financial conditions restrictive, which would then filter via financial markets, right? If we're overly restrictive, that would filter into demand, right? It would stem demand. Do you see stem demand anywhere? I don't. People are out and partying. They're everywhere. Spending money everywhere. Wages are keeping up. Do you see mass unemployment? I don't. I see less jobs on offer. I think that concerns me. I think that is the start of some badness down the road. But is it today? No. Will it be used as an argument for seasonal weakness coming up in the next month or two? I bet it will. Will it be real, though? No. No, they don't price that shit in. If they did that every time, we would be pricing in a recession twice a year. Or stagflation twice a year. We're going down again, bro, another 30%. Why? Well, we think there's a recession coming. Are we in a recession? Or even do we put together 3-6 months that shit? No, we're just going to price it in. We're down 30% a year. Bro, we're going to be at zero in like a year and a half. So you do need to have some of this data come in month over month, 3 months, 6 months. And the Fed has tools. So the Fed's policy rate is not that restrictive, is it? I know this is counter to every fucking thing you read, every fucking thing you watch and listen to, every asshole on FinTwit who tells you otherwise. The Fed's policy rate, right, is substantially higher right now, right, than inflation. You're told that, aren't you? But it's not having the desired effect, is it? So are rates restrictive? Probably not. Or else we wouldn't see that inflation, would we? Or it's a one-off from tariffs. That means we have to make sure that it's a one-off from tariffs. Do we have a tariff deal? No. You know it. We have some deals with some smaller countries. Do we have real deals? No. Here's the deal. I'm going to go tell everybody we got a deal. That's what's going on, right? So we still don't quite have a deal, do we? I'm telling you what the deal is, and this guy's going, fuck that guy. I don't agree to this. I'm gonna counter everything he says. I'm gonna wait him out. I've got till midterms, bro. This fucking guy could be hogtied by fucking next year. Not even. Election season's coming up. My wife is I was going to say a joke, a really harsh, bad joke about my wife. My wife's on poly market, bro. We're in a poly relationship. You know, once those numbers hit the market, right? The tape. Trump's losing the House and the Senate. You know what that means, right? It mattered before, but it doesn't matter now. These countries think that shit. Whether they're right or wrong, I don't know, but they're thinking that. Yeah, we could hogtie this guy in the midterms, bro. Then he's a lame duck the last 2 years. No one's even going to pay attention to him. This guy's telling us we got to just don't even respond to him. He told us that was the deal. So there is some of that going on out there right now. And there is, do we know if this is one-off or no? We don't know. And nothing's telling us otherwise right now. So financial markets as of today have blown that theory out of the water, haven't they? Or it's the one-off tariffs. If we're overly restrictive and inflation is going higher, it either means that fucking theory is fake bullshit, doesn't matter, Fed's inconsequential, or we're in the midst of some kind of tariffized inflation. And possibly even missing a window of cuts coming into natural inflation that's lurking around the fucking corner. We could have cut rates in the spring, bro, and in the summer, bro, but we're fucking around with tariffs, so we couldn't do any cuts. And now we're getting back into the beginning of a new cycle, like cyclical behavior, business cycles, inflation cycles. And it's starting to peek its head up. It's either tariffs or it's natural or a combination of the two. Stocks have risen from record to record, haven't they? Longest run we've ever had. Longest number of days without 1% down since 1993, 1973, 1965. Whatever the fuck those numbers are. I forget the exact dates, but we're blowing records out of the water. We get meme stocks going crazy. Yesterday, what did Nomura say? What did McGilligot say yesterday? First thing that I notice is that anyone that's hedged is getting angry. They want paid right now. They're so angry they're taking their hedges off and getting long in the market. They're unwilling to wait. They didn't structure it right to handle a trip to 6500. They didn't put enough time on it. So now they're getting long again. You know what that's called? Risky behavior. You know what risky behavior is a sign of? Not stagflation, not recession, not can't pay for the overpriced restaurant dinner. They might choose not to, but they have the ability to. So the policy is not restrictive. Goldman Sachs reported a 36% year-over-year spike in equities trading volume in Q2. Charles Schwab reported a 38% year-over-year spike. Morgan Stanley reported 23%. Fucking bears at Morgan Stanley. You don't want to do that. Is that a message from Mike Wilson? In credit markets, spreads between high-risk junk bonds, right? That's like the 2-year. And Treasury securities are historically narrow. And there are some exceptions. Powell talked last time about the housing market. He's been talking about that a few of these meetings. As a matter of fact, I made a comment on one of these meetings. In one of these meetings, all of these fucking reporters were asking the wrong questions. Do you remember at one of these Fed meetings where they were like, sentiment is in the shitter, and the hard data doesn't match the soft data? And he was being nice. He was like, yeah, it's politics. Nicely, I'll say it. Never in history have we had politics, social media, which is how you consume everything today, impact sentiment and not match. We had one other instance where it didn't match. We did have one other instance. But generally speaking, you've never had those two not match. And what did the reporters want in that Fed meeting? They wanted a gotcha moment. It's almost like out of a bad B series movies from the 1960s. Yeah, you got Johnny on the spot reporter. He goes into the office one day. And he's got like the captain in the police department as the boss. Jimmy, if you don't get me that story, I'll have your ass to be on the street. What do you want me to ask, boss? I don't want to lose my job. Ask him about that sentiment. And what he did was the first thing he spoke about was commercial real estate. And nobody gave a fuck about commercial real estate. Not a single reporter. They just blew it off. It was like the first 3 minutes. I'm like, that guy just said what they should be asking questions about. If there was anything wrong right now, it's probably a few things. Commercial real estate is bad. Housing market, bad, but not in the same sense. In terms of a crash. Not if you can afford a home or not. Nobody gives a fuck. The data says you're well off. But commercial real estate's dangerous. Services inflation is bad. New jobs is bad. They're not bad enough to warrant a crash. But those are the places if you want to be looking to start looking. Is this deteriorating? Can I get 3 months of bad data here? Can I get 6 months? Can I get a trend? Is unemployment rising? No, not in any significant way. Is there any velocity? No. Employment there is. There's a little bit of bad news. Now let's talk about the loose side of financial conditions. We don't like talking about this, do we? Because of politics. I'm voting for this because they're conservative and they're not going to spend. They're going to get this in line and that in line. They're going to cut everything. They're going to investigate and convict for fraud. I got Doge, I got this, I got that. That hasn't been the truth, has it? This is like me meeting with my teenager. That's not the truth, is it? They're all liars, aren't they? Margin debt blew out, spiking 8.3% in May from April. It blew up more to 9.4% in June from May, to a record of $1.01 trillion. Do you know what you need for a bull market? Spending. Blow out the debt ceiling, blow out the deficit. We're not restrictive. In dollar terms, June was the biggest month-to-month spike ever in history. If you're a conservative, I don't care if you're a Democrat or Republican, I just want to tell you right now, you know what the government just told you? Fuck you. Biggest month-to-month spike ever, $87 billion fucking dollars. You know the last time we had spikes like that? You want to know? 1999. Blow off top. It was a blow off top that began in the mid 90s, began to end in late 1999 for individual stocks, and then engulfed the rest of the market about 6 to 9 months later. Sounds familiar, doesn't it? Sometime next year. It was just before the dot-com bubble imploded. Took about 3 years. Took like 3 years to get down there, but it happened. 3 years later, the NASDAQ was down 78%. 3 years, right? 2002, 3. And then what do we go into? Super ramp again. And then we had the GFC, didn't we? So the Fed's policy rates are not restrictive. Now we have one more issue. GDP today was good too, wasn't it? Can't have a bull market if you ain't spending, can you? And we have another thing here. We've got some policy and politics. Last week we had one of the most bizarre things I don't know if it's the most bizarre, but it was pretty close. One of the bizarre instances I've seen recently was when Ukrainian President Zelensky was in the office of the White House. It was a disaster. The second time I saw was with Jerome Powell. Earlier in the day, they said there was going to be an executive order signing in the White House. Then they canceled it. And I said on the show, I wouldn't fucking put it past them going to the Fed. And sure enough, like an hour or two later, they're like, he's going to the Fed. It was one of the most bizarre things I've ever seen. And there were like 100 moments in that short thing. I mean, I was like, where are all the Mexicans? Where the fuck are they hiding the illegals? They must have all been like scurried and cornered in the second floor or something. Like it was all like perfect, you know? It was like a set. There's so many takeaways from that fucking walkthrough. It was a disaster. But it does show that some of that is probably there today. So the Fed is not restrictive enough. How does he word that? We still have uncertain policy, although it's making progress. That's good. Sentiment is that we're making progress, that there'll be deals soon. That's good. But there's this like fine line he has to walk today in his words and verbiage. He did that in that interview the other day. He was listening closely for any fucking stupid shit to be said. And there wasn't there? So it definitely clearly shows, or all this data shows that the Fed's policy is not restrictive, but Powell needs to phrase that today in a way that is calming the bond market, calming to some extent the White House. He needs to be able to interweave like, hey, we're not overly restrictive. We're open to being less restrictive, and we can see some progress being made from White House policy. The economy is good. All-time highs. We don't know if it's sticky or not, or persistent or not inflation. We do have a little bit of inflation coming up over here, but we still have higher rates than the rate of inflation overall right now. I think the bond market wants to hear that today. And the bond market's response will know soon thereafter. And I think today, if there was something for you to watch closely, it's Jerome and how he words his statements today and how he placates both sides. I think this one in particular is critical for that. You want to placate that the Fed is aware that there's inflation that's unknown if it's sticky or not, or persistent or not. They're paying attention to it. They're working on it. And you also want them to let you and everyone else know that they're not going to over-tighten. They need you to believe that. He needs to explain to you that the Fed is not overly tightening. He needs to get that across to the people that are demanding cuts, and he needs to get across to the bond market that they're still not ready and they're aware of this. So I think that's where we are for today into 2 p.m. I think you're going to see him attempt to placate the cut crowd and placate the bond market. And I think he needs to do both of those things at this point. And as long as you get the carrot dangled in front of you as a bull, I wouldn't care if you got a cut or not. If you get a massive succession of cuts, it's going to be for cause. And I also think, like, unironically, if you want to know the inside, I think Powell knows that at some point in the next year, they can cut aggressively. And he'll be exiting. And it'll be a nice clean slate for someone to come in and a good slate as the next Fed chair to cut. For cause. In a meaningful way that you've always wanted, even though I don't think you're going to like where we are in the market when that happens. $12:00, buyers stepped in. Instead of being sellers, driving it higher now. Still parked sideways. We have some upside and downside targets here. If you're a bull, here are your upside targets: 637.33, 637.12. You also have a target of 638.47 and 639.33. If you want to see where R1 is, it's 637.84. So if you're bullish on today, or if you're like, hey, we normally go down, then up, or we go up and then down, if you want to take the top and bottom side of the trade, hey, I'm just going to react. If it goes up, I'll sell it. If it goes down, I'll buy it. Unless there's some really bad news, or there's some like rate cuts that I can't step in front of. We're going to vertical, right? So I'm going to start it again. You ready? You got 637.12, 637.33, 637.84, 638.46, 639.33. If we were to go with an upside or a downside move today of 1% or less, let's take a look at what that looks like. Whoop. That's 50% to all-time highs. Not that far away, right? Not that far away. The other 50% for the full 1% move is down here to 632. Let's go look at this together. Perfectly priced in, right? You got your upside and your downside right here. If you wanted to live on one side or the other as a buyer or a seller, if you wanted a strangle or a straddle, there are your targets. All-time highs, buy the dip. If you're not expecting this huge move today, there it is right there. You get some bad news right here. What does that say? Accumulation zone, right? You'd need a greater than 50% move on the downside. If you're all bulled up and you get the swing lower and then you hit the upside, you get your 1% move. All-time highs. No breakout, no breakdown, no nothing. Today is supposed to be a wash, right? Nothing out of the range of expectations today. For downside moves today, if you wanted a target and you're like Jim James, you're out of your fucking mind. Monday was the high. Monday open was the top. We're going down, and today's the trigger. And we're going to sell this shit down to the depths of hell. Your downside targets today, after the FOMC rate decision, if you wanted some downside targets today or Friday, we've got some downside targets. $635.58, $635.21, $634.51. Bottom target, $633.51. I would say to you, unless you get some nasty news, like nasty, watch out for buyers down here. They're going to be down here waiting. Market trading higher now, trading 636.48. If you want to know what my positioning is, I'm long. If you want to know, I'm long. I've been long since yesterday's lows. I'm long into Friday. I'm long into the first right now. I think we go higher. If I had to like jump on a fence and you had to say to me like, hey, Cap, where do you think we're going? Higher first. Unless something changes. Unless there's something I'm missing that you see. Everything I'm looking at says higher first. Sell that top. Whatever that is. That's 64.50, 6,500, 64, 6, anywhere up there, start selling it. In the market, the options market's changing. Unless I see calls rolled to 6,600, that is the top for now. But the market's not dead yet. We haven't lost support yet. None of that's happened. So I think the way is higher. I don't have a ton of conviction in the bulls. I'm losing conviction like 100%, 80%, 60%, 50, 40, about 40% right now. And it'll dwindle as time passes. But for right now, the bulls are still in charge. They keep fucking buying. And until they stop fucking buying, the way is higher. And until we break trend convincingly, and today is fucking July 30th, you went sideways for a week. You got no down during expiration and OPEX. You got no fucking down this past week. There's still accumulation. Until we break that, we get a big fat red bar down, and then I'll go with the bears and I'll suck them off for 3 weeks, 4 weeks, 8 weeks. I don't care. Until we find a marked bottom and reverse. And I'll tell you the bears are in charge. But we're not there yet. So if you want my conviction, the way is higher. The only thing that could fuck this up today is his words. That's it. And he ain't that guy. Jerome is not known to do that. Jerome is a peacemaker. Every once in a while, he'll be bear. Only if he's been pissed off, normally by the public. I think he really cares about the public. And don't get me wrong, I think Jerome is probably the worst Fed chair ever. But I also think he's one of the best ones ever, too. That's a hard pill to swallow for me. I used to hate Jerome. Worst ever. And now my view has changed slightly. I'm shocked that they were able to rein in what they did. I'm absolutely shocked. They've done what they said they were going to do. I got to give them that respect. That same, it's not just one-sided. I'm impressed. I can't believe how impressed I am with the pure spite I had for Jerome. But I gotta say, I gotta give it to him for going outside of the norm and then swinging it all back into some kind of norm. He should stay on policy and on path right now, and he's doing that. And I think that's a bull's best friend right now. I really do. I think the other path is a path to destruction. It really is. So I'm bullish here. I'm bullish on the day. I'm looking for dips to buy, any and all dips, until the buyers stop showing up. And they have stopped showing up, not enough. If they were like huge buyers last week before, and all that, they're probably down to like 80% of their full strength. But they're still not. They're still fucking there. So until we lose that, way is higher. If you want to know where I think we're going, higher. Time frame wise, bulls have until, let's give it August 3rd. Bulls have for new all-time high from today until August 3rd. When do I think that print comes in? Fucking Friday at the close or Monday opening bell. Do I think we sell that? Yes. I think you take another stab at it to sell. I won't be a buyer there, just like this Monday I wasn't a buyer. Monday morning I woke up and I go on the Discord and I go, don't do anything. You're not buying that. You're not buying this. You're out of your fucking mind. You fuck no. And whenever we get this high, you're not a buyer there either. You're going to watch and see if price comes back down and gets bought again. If it gets bought again, I'm going to go up there again and tell you as a bear, fuck you, you got nothing. You got to wait until the 18th. They bought it. But if they don't show up to buy it next week, right? I think next week you got a nice window. Like Monday through next week, you got a good chance of breaking the fucking buyers, getting underneath, telling them to fuck off. I think next week sometime you get a good chance at it. So it might be today, but for right now, until something changes, that's where I think we are. And price proves that too. So I just think you have to be logical about this stuff. I think money matters in this stuff. So we fuck around money, not with bullshit fucking Main Street USA zeitgeist bullshit. We deal with reality. Right? So way is higher. Sticking to that. They've been all over me all week long too. All fucking week. I'm pissing them off. I'm out there in fucking socials fucking with them. I got the stick in the fucking cage. And I can tell you for sure, 80% of people are like, I can't fucking wait until we lose that goddamn island. And they've been hoping for it all week long. Today is Wednesday. I'm here. I'm your target. I'm your bullseye. We're not there yet. The moment we are, I'll give you a big round of applause. But I don't want you to get fucked either. Don't think I hate sellers or bears or any of that stuff. I don't. I just want to tell you when it's real. Hey man, it happened. Get short, bro. Let the hair grow out. Rip your clothes off. Show your anus to everybody. Whatever it is you're doing, get your bear freak on. We're just not there yet. And when we are, I'll let you know. Because I find those fucking people disingenuous that do. And people lose a lot of money. And I've lost a fuck ton of money listening to those fucking people. Because they say this bullshit every fucking week. And you end up making, $500,000. And you're like, that's it, I'm going in. We're going to crash to zero. And it doesn't happen. Up and to the right. And even then, you should be looking for pullbacks to buy and get long. Trading 636.67 right now. 12:30 in the afternoon. I think that's all you need. I could, if you want. How about this? I'm going to take a quick break. I'll put on the news squawker. If you want, I can give you all the diarrhea you want today. I got lists and papers, and I've got what GS is doing and UBS is doing and MS and you name it. I can give you the litany. Read it all off to you what they're thinking. I can do all that for you later, or not later this afternoon, but the next, next hour or so before the Fed FOMC meeting. Otherwise, if you don't want that, when I get back from my break, we can wait for the FOMC and I can start to look at some of the reports after the bell. I can look at some of the reports tomorrow. I can even look at some of the reports next week if you want. You want to look at some more big tech reports next week? I can do any of them that you want. I can do them from right when I get back to right before the FOMC, and then I can come back and hit them all again after FOMC if we can get done, wrap that up at 3 or 4. I could even stay later today if you wanted to and try to get some more of these reports that we got coming up. Not today, but like tomorrow's. I could do today's in the next hour, and then I can do like tomorrow's after the bell. I can do next week's. I can do all the big Mag 7s that are still ready to go. Whatever you want. Okay? I'm going to take a quick break. Just 5 minutes. I'm going to drink some tea and some coffee. Well, not tea and coffee, water and coffee, and then I'm going to go work out for like 5 minutes. I got to get my blood going so we can make it through this entire day. Way is higher. Price target, 639 and change. Pullback, and then we're going to trade. Oh, boy. Fail 648, and as long as we hold like 630, we'll trade like 658. And then I got another target of like 665. I think those are all bullshit right now, but they're if we stay bullish into late September. But that whole trade is dead if we lose this support. We'll talk more about it later. I do have targets. You guys all are like 600, and we're not going any lower. We're not going lower than 612. Not going lower than the 595. Dude, I watch that shit, but then I watch the upside targets too. Like if we continue higher, I got some targets for you. I really do. Your new base would be 630. 630, 6,300. All that shit comes back, but I don't see anybody talking about that stuff. So no, we'll talk more about that later, though. I'll be back. Give me like 5 minutes. And I'm going to put the news squawker on for you here in the background. And by the way, if you've never watched this show before in an FOMC, I will have Jerome Powell live. I'll have the news squawker giving you play-by-play. And I'll walk you through all of this stuff. I'll be back in just a moment.
Airbus will open second China assembly line this year.
Hello, everybody. This is Donald J. Trump. Yeah, it's really me. And I'm going to do a little advert for Financial Juice. You're behind the markets. If you're a real day trader, go real time at financialjuice.com/purchase and save 67% on a subscription. Can you believe it? Instead of a 67% tariff, you get a discount. It's huge. Very, very big. Very big. It was as big as my hands. Huge. Well, not as big as my hands. My hands are bigger. What are you waiting for? Come on, do it.
So in 10 minutes' time now, at the top of the hour, Trump is due to be signing a congressional bill, according to his roll call. So we saw earlier reports that Trump is signing into law a VA home loan program reform bill today. So again, that congressional bill due to be signed at 1 p.m. Eastern Time at the top of the hour. It's been 5 minutes time now at the top of the hour. Trump due to be signing a congressional bill on VA home loan program reforms.
Korean ministers held trade discussions with London and Korea on Wednesday. So just a reminder with Trump's event, it is closed press, so not expecting any live stream, but that's been pushed back to 1:30 p.m. Eastern Time.
All right, here we go. Here we go. Do-do-do-do-do-do-do-do-do. Do-do-do-do-do-do-do. Start off. Do-do-do-do-do-do. 12:32. We're gonna do it right now. What are we looking for here? Option earning report. All right. All right. All right. Let's see where we are here. If you're so we're going to spend just a few minutes here before we get into earnings. We're going to talk about earnings that are happening today after the bell. If I can get done before the bell, I'm going to try to get done Meta, Microsoft, Hood. We'll start there. If I can do some quick takes, I will. And then what we'll do is we're going to then go in and do, if I can't get them to them today, at the end of the day today, or in a private stream for the community, I will do a private stream after the bell, and we'll do Apple Amazon, Coin, Reddit. We'll try to get to like Riot, Carvana. I don't think I can get to Carvana today, but I'll try Qualcomm. Maybe I can give a quick one on that. Quickly on Ford. Ford's report is after the bell today. I live in Michigan and Detroit. It is noteworthy. I don't think it matters today, but it is noteworthy that Ford took out a multi-billion-dollar loan.
Reverse reappropriation data.
They were approved yesterday. Last time they did that was in the GFC. They did it before, though, about a year before the GFC. No, not the GFC. Tech bubble, I think. I think it was a tech bubble. It's either the tech bubble or the GFC. It was one or the other. But just noteworthy that they have an earnings report after the bell, and they're under a lock and key to speak about the deal right now. And today they're going to address it. So I'd pay attention to Ford. That's just notes on after the bell reports. You want to pay close attention to what Ford has to say. They're one of the companies that are being heavily affected by not only the new car market, but they're being affected as well by tariffs. And in their view, there's economic uncertainty still because of where they are with tariffs and their outlook into next year. I'd be paying close attention to that, mostly because they're one of the few companies in that time period that was proactive, looking for credit before there was a credit crunch. And I think it's noteworthy that one time they did it, they're doing it again right now. Not that that matters today. That doesn't have anything to do with today, but just pay attention to what they have to say in your farther out looks into next year. Maybe insightful into 26, 27, or 2026, 2026, 2027. So that's the first thing I want to talk about is Ford after the bell. Also noteworthy too is that Ford generally follows the S&P 500. So if you're looking for some kind of a mirror of the U.S., I think Ford is a good representation, or at least the price of the stock and some of the moves that they make in this country. So look towards Ford.
Well, it's me again. It's Donald J. Frickin' Trump, okay? And if you're sick and tired of hearing my voice in this ad, which is pretty sad,
turn that off. The next one that we're going to look at, or the next one that we're going to take a quick peek here at is Meta. It is interesting right now that Meta and stocks that were high flyers, like infotech that didn't rely upon tariffs, were boosted while there was a lot of tariff uncertainty. And let me just take a quick look at this here right now. I want to make sure I got everything right here. Oh, fuck yeah, they're buying that dip. And I want to talk to you. This is important too, because Meta did this like big run up into so last year, right around middle of summer, we kind of got the picture quite quickly that Biden was not going to be president, right? Whether that was whether the DNC did that to him or someone did that to him, someone did it to him, right? Set him up. Even if he was that guy, they set him up for that. He didn't have to do a debate at all. He could have done no debate and had a better off chance of being president than that debate. At that time period, Trump ramped. For about 2 or 3 weeks, when Kamala announced she was going to be president, she took the lead. But then it ended quickly. From that point, right, we began to price in blue chip companies that did not rely a lot upon did not rely a lot upon tariffs, and they ramped. They basically went vertical and didn't stop. And then when they did participate, like the rest of the market does in a market downturn, in into April, and they've ramped since then. They made a new all-time high at 747.90. Now, interestingly, I had someone say to me earlier that the thesis here would be if we have these tariff deals, you'd still want to go with these companies as outperform because they're not going to get the hit from tariffs, right? They don't rely upon that stuff, basically. And we're not in a major trade war. We kind of are in one, but not really where we're not doing business anymore between countries, right? So Meta's not banned everywhere around the world. Meta's not, the workers are still around the world. They have remote workforce everywhere. Now, they did make a new high. They did get an equal high in this year chart that I'm looking at on Meta. They are beginning to break trend. And they have been breaking trend and underperforming since June 30th. When I tell you that these things begin before we get there, you can see it clearly and plainly in the Meta chart. They caught a high on June 30th, and since then, it's been faded. They broke trend, upward trend. Let me just take a peek here. They broke upward trend on July 9th, right? They began to unclench and unwind a little bit. So Meta's been kind of falling and failing to the downside. And a lot of people are pointing at Meta and saying that's why the market should roll. You can already see the weakness here in Meta. And in fact, I was told another thing this week where someone said, that trade's dead. All that infotech stuff, they're rotating out of it into other concerns right now. And I'm like, all right, that kind of makes sense. Where you'd expect infotech to continue higher, there's now that's kind of been priced in to an extent. Tariffs, uncertainty. And this kind of shows you that trade is unwinding. Does it make sense? You get the winding up, and you get the winding down of tariffs. And Meta seems, or it looks like price-wise, like it's a victim of that. Now, there is one key point here in Meta. They had the prior high here on February 14th of this year. They made the first part of the bat wing on the second half of this year. The early year high was 740.48. And they got it by a few pennies, not a few pennies, but relatively speaking, on daily candles, they got the new high at 747.90. We also know that it's hard for stocks oftentimes to break 50 or zeros, right? 5 or zeros. They're going to get sold at those big round numbers, aren't they? They took the first shot at it back in February at 74161. They took another shot at it here at 747.90, but they did get the new high. If you look at Meta, it looks like a cup and handle, doesn't it? If you go on a daily chart of Meta, it looks like a cup and handle. It looks kind of bullish overall. We already know that we're late season for bulls, right? And we've got an earnings coming up after the bell today for bulls. They also have some pretty big gaps down below. They got gaps at 625, 605.14. They got another gap at 548.05, 569.22. They got some gaps down below, at least on a daily basis. Let's see if I can show this here. S-Bucks. Meta. I can show this over here. If you're looking at Meta over here, this looks pretty bearish to some extent, right? Well, you can kind of see it here. They did an unclench over here. This kind of looks like cup and handle, doesn't it? Got a cup. Whatever this down move is should result in an upside move. There is some danger down below here. You can see these gaps down below. This isn't where 600 is either on SPY, is it? So maybe some individual tickers are looking at more doom. There is some other information here that's needed, though. And I want you to pay attention to this in every stock you look at. This is a stock. There's no indicators on this. There's no nothing. There's one line here, trend line, right? So we're going to look closely at this, and we're just going to look at candlesticks. These are important to pay attention to. I talk to you guys sometimes about the old timers and how they didn't use indicators. They didn't use anything. They just used candlesticks, like simple trend lines. And they have a very keen eye. Old traders have a very keen eye for this kind of stuff. So I want you to look just closely here for a minute. You got a prior high. Then you want to look to see if you got the new high or not. And we did. You got a new high. We always talk about Poop Island. Right? Poop Island, right? We got a bunch of them. You got them on every kind of time frame. You'll always see these Poop Islands. In this case, we're in a daily chart, candlestick chart. And you got the new high up here. So just simply put, like really simple stuff here. You've got the instigation here all the way up here. Wait a minute. You get the instigation up here, right? Then you're kind of expecting this to hold higher than the last support. Does that work there? Something like this. Something like that. Maybe I can move that over. Well, this looks kind of bearish, doesn't it? On its face, looks terrible, doesn't it? But we do have the high up here, right? We do have some demand down here. You can see the roll down, right? No, and they push you back up. Yeehaw, right? Down here. We're going to sell you. We're going to check on you. And what did they do? Suck back up again, right? Same buyers. Now we're coming into some seasonal weakness. When you come into seasonal weakness, you can oftentimes see these sellers. They're in here. They want that big payday, right? Kind of see it, right? What are they looking for? They want that blood down here, right? It's juicy, isn't it? But we still have to contend with these buyers over here. And I also want you to think about this. If you're looking at this and this looks bearish, you can see that the sellers know where to sell, don't they? They know where to sell. You know, you're selling in these highs. The buyers know where to step in. So even though this looks bearish, I want you to think about like where are the people that make money in the market and where are the people that make money up here in the market. You know, are you bullish when we're up here or are you bullish when we're down here? And if you're a bear, are you following these guys? And you gotta expect that buyers are gonna step in, right? Now we are coming into some doomish part of the year. But it's important to remember that these buyers keep stepping in. So just plainly, right? Nice and simple. You know these buyers are here. You know these buyers are here. And that's where we are right now. If I was trying to sell Meta, sell it from where we are in price today, just not looking at anything else. I don't mind this right here, but in truth, I would rather be higher. I like that. That's good. You could leave some runners on here, but I wouldn't be trying to execute a trade here. At this point, I'd be wrapping it up, leaving runners on, but I wouldn't be executing a trade here, personally. But if you do see like a break of this stuff and then a rejection with a new low, I think that's, instead of being up here, I think this becomes the new sell point, right? Otherwise, you're going to expect buyers to step in. It also brings up another question of, do we go down here and then we fuck around in here? Maybe you catch that tip down there and then it's Rampo-Rama into the end of the year. Like you've maintained this whole entire diamond, right? And you're still a buyer down here, depending upon your poison. So I think that this like level here is key, right? This level is 680, 690, 690.96. That makes sense, right? 685, 6850. Right? Makes sense, right? Still bullish. So if you're a buyer on Meta, being a buyer down here for later prints, I think is good. As long as you're holding this up, this diamond, this poop island. If you begin to lose this down here, you can turn into a seller, right? Sell calls above. You can also cut it loose and wait for the next buy point, which is much lower, right? But your thesis-wise, this is where you become bullish, not bearish. So you're kind of like looking for anything down here to buy and any excess that you can find. And I'd be paying close attention to this diamond right here. Very close attention to Meta, adding for a later print later in the year. Now, if you think the bull run is over for the year, we're going to go into this big jackknife second leg down bullshit, and the fall is going to be terrible, and the top is it forever. And I don't know, for the next 3 years or something crazy like that. Disregard what I'm saying to you. But if you are right now, we're kind of long in the tooth being a bull, coming into a report for them, you're going to be looking for any kind of signs from now into middle of September for some kind of low to buy. I really don't even care about this. I care about if this rejects and goes lower, but if this like if we go down into like some part of like weak season and then it sucks back up, I'd be looking for that long into the end of the year. Right? Big, beautiful, whatever. That's just on base case for earnings. Now we're going to take a look at some more information that we don't have access to with just candlesticks, and that's momentum. We're going to talk momentum right now on Meta. If you're a systematic trader, you always want momentum on your side. Always. You want Momo. You want to be going with the market where they're going. Right now, Meta's on the way down, isn't it? So you try to catch a knife here, you're guessing to some extent. There's some stuff to look at here in Meta too. We're going to first check with its velocity. That's Momo for you. Remember too, looks like quarterly could do a little bit more, but it's near top. Monthly has maybe another leg or two in it, as long as it holds that diamond. This is getting a little long in the tooth here. Meta is. And remember, they already had their kick-ass trade. Right? They've already been kind of priced in. A lot of money made here on Meta. They also have a series of declining weeklies here. That's bearish. This is pointing towards some kind of doom in the fall. If you can break that down here for a quarter, it might give a little bit more lift here, a little bit more lift here at the end of the year. Now, this is all, of course, predicated upon Not their earnings today, but the fall, whatever that seasonal weakness is. So this is Meta. I don't like their daily velocity either. I do not like it. I do not like declining on this at all. I would prefer daily to be down here, coming up, like right here, or already ramping higher into this high up here, like this part of the trade. I like that part of the trade. Like I like that better. In a better world, just like this. I think that's gorgeous. Coming down here in a low and weekly, broke down this a little bit. It's great. We actually went higher. Noteworthy too, nobody sold on higher frames. Nobody sold on the monthly. Nobody sold on the quarter. This is important too. This is also telling you that, Mike that's like 65 years old and buying Meta for decades, he hasn't sold shit. Nothing has shaken him. Not even the move down this spring. They stayed long. On a 30-minute basis for velocity, this would be intraday trading kind of stuff. It actually looks kind of bullish. Not bearish, but there's a little bit of accumulation going on in here. You see it? This is likely tied towards its earnings. This is July 18th. Even though price is going down, there's some accumulation here for a print. And on the 30-minute basis, this looks pretty fucking good. On an hourly basis for an upside move. So both of these things are telling me two pieces of information. It's telling me that people are long here for an upside print. Velocity on a 30-minute basis intraday looks good. Believe it or not, looks good. But then it looks like it wants to come down for a higher print in later end of the year, depending upon market conditions, of course. So let's look at this on a daily basis and go back to that triangle we're talking about right over here. Kind of see those gaps there and this gap here. If we have the weekly, if we have the seasonal weakness, we're going to go down to at least 640 and likely close at least one of these gaps. So you close the gap, you go back up for the winter trade, come back down next summer or spring and summer to take this one out. But there's still some legs here, like this, then this, then that, then this next year. Forget the dates down here. This is not important. It's more the major inflection points. Close that shit out. Get some more ability to short into the fall, right? Come back up for the winter. And then we do the thing into the spring and probably into the summer. So Meta. Let's start back on the monthly. Some juice here, right? Nice targets to the downside. There's 617. There's 551. We're about to put in another monthly candle. We could, as I talked to you about monthly candles, I already told you, like erase all this. 644. Excuse me. On a weekly basis, target 666. Here's where all that sell pressure is. This is not to be trifled with up here. This has been growing right on the underside of the market. Saw that on SPY as well earlier today. Also noteworthy, the daily trigger is flattening. It's not quite yet bearish yet, but it's flattening. That's usually neutral to bearish. We want to take a look at this right here. We got another target up here. Another target right here. Another target right here. These fucking bears are ready. There's another one right there. Now, again, I want you to think about what I told you earlier. Just like SPY, buy, 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 buy. Has demand left Meta yet? The answer is no. They also have an earnings report. They also have declining resistance. Ping, sell it, ping, sell it, ping, sell it. Nope. Reversal. Uh-oh. 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 And then right before earnings, flush. Looks like they don't want to print that shit right now. They don't want to print that, do they? SPY squeezing higher right now. Trading 636.81. 141, 19 minutes before we get to FOMC. Go to a 1 hour basis. That's like squeeze central, isn't it? SPY squeezing higher now, trading 636.81 to our first target of 637.12. We only need to trade 636.90 and we can roll to the downside on SPY. A lot of bearishness in here, huh? This looks bearish. Meta looks really bearish, doesn't it? It looks horrible. Make that one red. The you shall not pass line. But it's weak. We have hourly velocity is ready to squeeze. This hourly right here is weak. That's weak. That's weak. Ready to squeeze and break through. This is all primed for a squeeze. All weak sauce. I don't like the new low. Here's the low from yesterday. Low from today is lower. This is implying that we're still going to roll over regardless. So take your money and run and then sell. Doesn't look good. In the midterm, it looks horrible. In the short term, it looks like it's ready to squeeze. It's still holding here, believe it or not. There's no prior low from July 18th. You also know that the instigation of this trade was on July 18th, and these buyers right here are still here. We haven't lost them. They bought again, took the money and ran. They got blasted to the downside, and these buyers are still buying. They're still fucking buying down here. There's still demand. They need a bad report, some kind of a miss. We need to be trading below this 692 to get the ball started to the downside. So I can tell you this ER in two ways. I can say to you, Look for a high to short. Close all that out. Just look for a high to get short. They look pretty squeezy to me. I think this would make like a great short into November, December. If you haven't had a chance to short Meta, you may be given one today. Or tomorrow, tomorrow, between like the 30th, 31st, 1st, somewhere in here, you're going to get another chance to short it, more than likely. Not guaranteed, but more than likely. I would not be short into this close on Meta personally. I'd be waiting up here higher. Higher to get short. Even if it squeezes up here, you can see it right there, right? Short lower. Right there. Still inside of this range. Want to see that break. So I'm either short up here or I'm short down here. But I'm not short where we are currently. I like shorting this below. I like shorting it up here. So if you want to be a bear, it's higher or it's lower. I don't like this down here as a short. I like this long in the short term to the upside. So for their earnings, I'm bullish. Start out like that. Fairly easy. Could be a little bit tighter in here, but close enough. Close enough to want to get short, right? Short, short, wham. Go back up there again, short. There can be a short here, but you want to see the break first. So the short is here or the short is here. Otherwise, bulls, bulls. If I had to guess on Meta, I would not be short, and I might not even take a long. I would just let them report and just be sitting up here to tee off. If they have a bad report, I'd jump on a short here to the downside. One or the other. That's probably would be my plan on Meta here for where we are right now. Waiting up high, shorting below. One or the other. Now for the bulls that are all geared up for a print, that are putting more risk than they should be, at this point, I realize that you guys want that print. I want you to pay attention to this upside here, right? And I want you to begin to look a little bit higher. Not a ton higher, but a little bit higher. I want you to look back on this high up here. We got that all-time high over here. I want to see that one fail. Remember, equal legs. I haven't seen it on this side over here. Haven't seen that equal leg failure. Wham, to the downside. We got it over there, but not over here. Well, there's that bull trade right there. Hence why you want to be up here waiting to short or for the failure to get short. So short up here, short down there. Bulls. Balls in your court. Equal highs over here. Are we in distribution? Probably not. I don't have that thesis that the bull runs over. We're in a cup and handle. We never got a chance to say fuck off or we're out of here over here, have we? Haven't, have we? We have until the 3rd, I said, right? To the 3rd. 15th. August 31st or 18th. It was August 31st, 15th. Right about there. Bullish on Meta. Not only am I bullish on Meta, I'm bullish on Meta to trade 736.26. Also want to see this new high up here for this prior high, although I don't give it any guarantee that it's going to happen. You could get a tick just above. Target would be 749.55. Though I'd like to see a failure of 760 into, you ready for this? Into the end of August. I think you get this big squeeze up right here. And this could be more vertical than expected. This could also be August 3rd. I'm giving you time or price, one or the other. We could go straight up here by the 1st or 3rd of August. I'll give you until end of Friday of the first week of August, and then a pullback in the market for the month of August. I think that conditions deteriorate in August, but not fully. I think you're also going to get one more face ripper up and squeeze before we get the real roll in September, October, into November. Now, I will say this. So I'd be short up here, ping, short up here, ping, but I would also switch short here too. So I think the better trade is short, personally, and I'm a bull. But even so, that we go way down here too. We're gonna close all that stuff out down there if you want to see it. It's all the way down. It's gonna like jackknife here, jackknife into September. You know, it's gonna be a fucking bloodbath down here, in my view. You're gonna get the roll over here. You can see it. You can see it right there, and the turn up into the end of the year. Kind of see it right here. Anyways. If I'm wrong, you want to have stops down below here. What they'll do is get this party started. We're kind of already know we're here. Get this party started into August. You know, can't get above it. Sorry, on your way to downtown. 4 to 5% correction in the market. You'll look for a turn to get long again in September, October if we start it early. As of right now, until price shows me different or earnings shows me different, I've got us going up into this close today in Meta. And I've got a target price above of 637.70. Nope, not that. No, I got that wrong. Yeah, no, I got that right. I want to see that full print. I want to see like 638.50. I want to see just the tip. Do we get there, though? I can't tell you that we do. So you got to rein it in a little bit. The expectation should be 735.79. So overperform or under-deliver, overperform depending upon where your price point's at. Don't be trying to trade this to a tick. You should be an observer up here. You should be already out. So if you're bullish, you should be like, I'm wrapping it up, bro. Shouldn't be jumping in here at the last. Oh, I'm bullish now, bro. And then you get caught in here. Don't get caught in this bullshit up here. So I'm bullish here on Meta into their bell. They're gonna squeeze the fuck out of these bears, and we're gonna go up there and get the equal high, and then we're gonna get the roll to the downside. And it's gonna be a fucking bloodbath. All this shit's coming back. But I think as a function of this bat wing here, you can kind of see the bat wing, right? Bat wing, big old W. And then wham, 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 downside. There's your next dip buy. Now, if I'm wrong, cut this shit loose, or you buy the stock, sell puts, close the sold puts if we begin to roll, or you cut yourself loose if you're just on the underlying. If you're on calls, you know the drill, right? If they roll you down here for a minute, that's not a roll. If we whipsaw back up, we're good to go. We know we get that fuck around in after hours. I think it's easy to trade lower into after hours. 695 is easily possible, but then the rip higher. And only if we get a low below 693.87 and a second low, then I would say cut your losses and look much lower in the fall. We'll get to that later. But I'm bullish on Meta into their bell. Oh, God, Trump's out there talking right now. All right, we're going to switch over right now back to the main screen. I'm going to turn on the presser. Remember that I'm bullish here. I'm bullish on Meta.
10 seconds.
10 seconds for the Fed's FOMC report. And I'll have Jerome on here in a half an hour.
No change, no change. Rate remains unchanged at 4.5% as expected. Fed says economic growth moderated in the first half of the year. Governors Waller and Bowman dissented in favor of rate cut. Fed removes language saying uncertainty has diminished. Fed says inflation remains somewhat elevated, labor market conditions remain solid, and recent indicators suggest growth of economic activity moderated.
SPY targeting 637.12.
Unemployment rate remains low, labor market conditions remain solid.
Coming into the first expected price target right now. Just tagged it. 637.12 just got tagged. Looking for a second target of 637.33.
Just keeping on the market reactions here. Dollar seeing some downside movement. There's a little bit there. And the S&P 500 did see a little bit of movement.
Note the two blues right here.
So the Dixie holding
there.
on to gains after the FOMC. White House says Trump signed a proclamation to address effects of copper imports on America's national security. As said with the S&P 500 and Nasdaq 100 climbing to session highs. I'm just reversing that move towards the upside.
Notice the pin strike, just a penny short. Keep an eye on that right there. You see your first target right here. See the pin strike right there, just by a penny.
Rate statement as well.
Told you earlier today that you would miss by just a penny. First target hit. Watch this downside target right here.
After Fed holds rates steady with dissents. So again, you had Waller and Bowman that preferred to lower the Fed funds rate by a quarter point. Trump says proclamation imposes universal 50% tariffs on imports of semi-finished copper products and copper-intensive derivative products effective August 1st. Seeing the US Treasury to 10-year yield curve steepens after Fed statement. And so the US 2-year Treasury yields trim rise in wake of Fed statement, last flat at about 3.879%. Spot gold unchanged after the Fed rate decision, last down about 0.7%. The White House says Trump signed an executive order implementing an additional 40% tariff on Brazil. Trump signed an executive order implementing an additional 40% tariff on Brazil.
Note that Dixie is trading 99.603 above where this yellow bar is that I have marked off here.
Information on copper imports
Is pretty bearish for equities. So be watching this closely. There is a Dixie short right now. Looks like those sellers are stepping in, but we want to watch 99.603 on the Dix.
Excuse me. Traders still fully price in at least one 2025 Fed rate cut.
Want to see it right here? That yellow line that I have there. You do not want to see a break above it.
Says that we have to pay attention to the two dissents.
US 10-year with a little bit of whipsaw. VIX 9-day getting bulled up right now.
Suspension effective August 29th.
VIX 30-day still kind of bullish. They have a gap to close above and a rejection above at the daily trigger at 1672 in the VIX 30-day.
Hello, everybody. This is Donald J. Trump. Yeah, it's really me. And I'm going to do a little advert for Financial Juice. You're behind the markets. If you're a real day trader, go real time at financialjuice.com/purchase and save 67% on a subscription. Can
The
you
Fed
believe
says, let me just repeat.
instead of a 6
Recent indicators suggest that growth of economic activity moderated in the first half of 2025. Not now, but first half. Inflation remains somewhat elevated. Unemployment rate remains low. Labor market conditions remain solid. All good news. Governors Waller and Bowman dissented, preferring to lower the funds rate by 1/4 percentage point, 25 BPS. Trump is also making headlines out there right now, trying to, I don't know, take away some of the coverage of the FOMC meeting today. He's saying he signed a proclamation to address the effects of copper imports on America's national security. The Trump proclamation imposes a universal 50% tariff on imports of semi-finished copper products and copper-intensive derivative products, effective August 1st. Keep an eye on Dr. Copper. White House, Trump also signed an executive order implementing an additional 40% tariff on Brazil, bringing the total tariff amount to 50%. I'm going to assume that Brazil told him to go fuck himself. And so Brazil's response was tit for tat. JP Morgan's Michelle comes out knowing that there's going to be two dissenters and saying we have to pay attention to the two dissents. White House coming out and saying something else that's important. The de minimis exemption suspension is effective August 29th. Michelle goes on to say, I expect Powell to say that there is not much disagreement in actuality. So Michelle wants to see what the verbiage is in the presser, and I am in agreement. How Jerome words this presser matters today. Keep your eyes on the DIX today. You do not want to see the DIX trading higher than 99.603. Mark a big fat line on that number. Sellers came in again to sell DIX as we approached that number today. Hold on a second here. I gotta hold on a second here. I gotta keep that. There we go. Sorry about that. I got the presser down below for you as it starts. Once it begins, I'll put it on for Jerome. This is where the real action is. We didn't quite get the lower bound here. We didn't quite catch 635.58. That's a good sign. Looks like the hourly trigger and half-hour trigger held us up just fine. Next target for bulls, 637.33. Thereafter, 637.87, 638.39, and then 639.34. If we get the 3 days up today, tomorrow, and Friday, and if tech earnings helps, you should see three green bars on today. Maybe a little bit of sideways tomorrow, and then a bigger move up Friday. If you're in the Discord, I said to you earlier today that you should get some squeezing higher. I said to you, when you get that squeezing higher, you may want to be interested in opening or certain positions. You've had your first squeeze just now for a high to 637.13. So if you're trying to min-max opening those trades, there was your first example. Meta's expected move today is 5.7%. If we go higher in the next few days in Meta, you're going to see those calls print. 5.7% is the expected move on Meta. Someone's wrong on Meta. Oh, excuse me. I got that. Yeah, I got that right. 5.7%. SPY beginning to head higher again right now. Remember that we blow volatility off as we come into these events unless we get something negative. You can see some of that vol coming off the event right now. If you watched me on Twitter this morning, I posted for you the expectation of volatility blasting down over the next 3 days. There is no expectation of anything outside of the realm of craziness. If you're looking for that today, you might find it in the presser, but I think that's it. You got to wait until what? NFP, baby. All eyes will turn to NFP on Friday. Jerome said today that unemployment and employment look great. There is some inflation concerns, but it's not that bad. Remember, unemployment numbers coming out on Friday at 9:30 in the morning. Maybe you catch a high print into the close on Thursday or the open on Friday. I got Trump trying to shit on my longs. Like, is he in his fucking bathroom right now? Another note here. I'd be wary. This is Michelle again, or Michael. I think it's Michelle. I'd be wary that corporate America is bottoming. It is learning how to absorb tariffs. I know that's not part of your lexicon right now, but in fact is what's happening. Futures imply traders see a 65% chance of the Fed lowering rates, at least 25 BPS at the December meeting. There's your carrot. For all you cut bulls, they gave you a carrot today. Again. No. I was saying about Trump, why is he should be quiet right now. He knows that he should be quiet. He can fucking spout off at 4 p.m., but he's not, is he? He's like out there right now doing a bunch of shit. You figure there's 7 days in a week, and he's doing this today on Wednesday at the FOMC rate decision. I think it's I prefer decorum. I'll say that. I'm an adult. I like decorum. You wouldn't want to see me knock your face off because I don't like you in a restaurant or something like that. You wouldn't want me doing that, right? And I realize it's politics, but this is not the norm. So I don't like it at all. I'll be honest with you. And I don't care what party you're in. I wouldn't want a Democrat doing it, a Republican. I don't give a fuck. I don't like it. It's bad. At any rate, so we'll go past all that. So I don't think he's shitting on the lawn, but I just don't like that he's out there like making decisions right now that are not important at this moment, and he's doing that right at this moment. Keep an eye on copper, though. What else do I got for you guys? Hold on here. So I'm bullish on Meta. Let's look quickly at the next report after the bell, so I can get these two out of the way. Microsoft. Hey, MSFT. I love them. I like MSFT too, by the way. And you guys are trying. These are the two heavy hitters. Like, I'm looking at all the other reports today, and I'm like, I don't know. We got a raft of reports after the bell. I pretty much have the same take here on Microsoft. I'm looking at them too, and I've got an upside target for them too. I'll chart this out for you in the background, and I'll post it in the Pro channel for you. Did I post that other one in the Pro channel or no? Sorry about that. Here's Meta. I think that's Meta. Meta ER expectations. Done. Oh boy, Microsoft, man. Microsoft might. All right, I might forget what I said about Microsoft. Not forget, but Microsoft has a big old thing to fall off of here. They're prime for a short. Woo. Let me just check Meta here. Excuse me, not Meta. Microsoft is only due for a 3.6% move. That seems appropriate here. Look at them. They don't have to do shit. Like Microsoft could have a flat and it wouldn't matter. A flat report. Oh man, this one, like Meta or Microsoft is just begging. Begging. If you wanted a short on both of these stocks, I would say Microsoft, man. Even if it's off a high. They're just stacking bodies over here on a weekly basis, aren't they? Just like murdering bears. Like just looking at Microsoft right now. This thing is just looking to get chainsawed down to the ground. I can see why bears want to short this fucking thing into the ground. Let me check the weekly here. Oh my God, this thing is just primed to roll to the downside. I can't even count the number of weeks of bullishness on this stock. This thing's been carrying the market. Microsoft has been beautiful. If you made money off Microsoft, congratulations. Time to bounce, huh? Can't be in this long still. There's no way. Just check this really quick on Microsoft. Bring this over here for you. 13 minutes until the next pump or dump. I mean, they're still holding up right now on a daily basis. They're in the same situation. I would expect that Microsoft sells before Meta. I wouldn't expect continuation on Microsoft in particular. They are in danger of take the money and run, in my view. So far, from what I've looked at, they look like they're take the money and run kind of a situation. Meta, I think, doesn't. Let me take a peek here. My God, Meta or Microsoft. 1 hour. Let's check this really quick. I like Microsoft lower. Just by looking at it, I like it lower. I mean, it's still bullish as fuck. Let me just check one more thing here. Oh, man, I want to short this fucker right in the close. The hourly looks like shit on the... Oh, hold on. Yeah, the hourly looks bearish here on the 30-minute. On a daily basis, it's saying there could be one more squeeze. Their weekly is still being accumulated. Maybe it's more bullish than you think. I looked at some charts on Microsoft the other day. And they still looked kind of good here. Man, it's still long in the fucking tooth, though, isn't it? You don't want a short strength. Let's look at this one really quick before we come back to the show here. Bring this over here. This is Microsoft. They only have a 3.6% move anticipated today. I tend to agree with that. This is a one. Let's go to a one hour right here. But there's a trap in here for bulls. I like. Let's start this right here. This is the 31st first. Yeah, I'm looking at that right now. This one shows the bull trap in here. This one's messier. This kind of looks like garbage. This one's got a it's bearish, but it's not bearish until later. Okay, so here's my take on check this accumulation. Wednesday, 1600. Thursday, 9 a.m. Friday, right there. Tuesday the 5th. Fuck around in here. You got another attempt at a downside move over here. That's a tough one. Less bullish on Microsoft. I think they've already done their thing. I want to see them come up here and trade this, trade that tomorrow. Hold us up into Friday. Bloodbath this shit Friday, Monday. But I think they hold on. I don't think they want to give it up. I think this one is done running, but it's not an easy one to sell. I think you need to get under here. This one's going to be a bastard. There's September. This one's going to be harder to sell. It ain't going to be easy. Even getting it down here into like September, October, it's going to be hard. Let's look at this, though. This one's got a big fall ahead of it. Once this fucker starts moving, this one's going to fucking tank. When you get these, like, this is a big hammer candle here. But when you're topping like this, it's fucking brutal. Like, look at that. They own all of that. They own all this shit. That's wrong. That's right. I think taking Microsoft down is going to be a process. I kid you not. I would not be short Microsoft until under $500. I don't think you have a lot of upside, but I think you got a lot of selling out to do before the roll. I don't think you have the upside ability that Meta has, but I think it helps the market today. This is going to take time. There's number 4. So you can see it. Go on up there and tag it, baby, before we get to 2:30. Here we go. Here comes the presser. I'm going to speed it up a little bit here.
Afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
I'm going to give you some commentary as he speaks.
Uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures.
Oh, yeah, get up there.
The unusual swings in net exports.
Give me the fucking money, baby! Trading 637.15.
In contrast, business investment in equipment and intangibles picked up from
Ooh, baby, can you do it to me again? Give me green bars when the week is on end.
payroll job gains.
Remember, we were crashing
50,000 per month
this week.
for the past 3 months.
Now trading 637.20.
1% remains
If the way is not lower, which way is the way that we're going?
wage growth
Bears you've had all week.
is still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased in 2022
Let's go shitpost on Twitter.
relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived.
Oh, God.
A one-time shift in the price level. But it is also possible that the inflationary effects could be more persistent, and that is
Next target, 637.80.
our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country.
Yes.
To our public mission. We at the Fed will do everything we can.
Good job, Jerome. Keep talking.
Employment and price stability goals.
There's a little bit of a supply here, boys. Here we go. Nick Timmeros, you over there on the left.
Sure, Powell. There's a lot of lean
I said, Nick, why are you going to this guy?
out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is.
Oh, what was that? That's supply? Who got angry there? What the fuck was that?
There's also downside risk to the labor market.
This is trend, by the way, just so you know. This is trend right here.
Inform our assessment of the
They're gonna try to drop it and then swing it high.
Just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of
Let's go look at the triggers really quick.
between now and the September
Fucking
meeting?
rage.
The adequate 2-minute
Look at that
decision
rage.
rates at that point.
So you're right. We
Just so you can see it over here.
an intermeeting period when we'll get 2 full rounds of
Rage up there.
the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the
We got another trend up here.
as we make our decision at the September meeting.
We got all-time highs right here. they're so shitty. Fucking dealers. Look at them.
That uncertainty has diminished from this statement. Does that mean
So they did it here, right?
increase? And I'm just wondering, the administration has struck
Hold on here.
several deals.
They did it right here. They did it again.
It seems like now
They
what the
fucking
rate-
full-on rage.
Does knowing that rate add to your certainty to change policy, or do you need
Oh,
to
we got Leisman up.
see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we
You
took
kind of know where the Bears are now, right? Right here.
diminish because it didn't move any further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Jerome with Axios.
This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course, will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody, and also from a dissenter, is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table, where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't, that you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. We're going to be at some point, when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, you know, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to, you know, to slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is, you know, substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. Consumers it's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but, you know, the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. You know, we haven't reacted to new inflation, but I mean, I wouldn't insist upon that. But I don't think, I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, though, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be
Yes.
for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
That is stimulus.
Let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say, when you think that, you know, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, what do you, well, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer, terms of interest rate charges?
Yeah, no, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria. Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work, and I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal.
You fucker.
As I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy, they use this data a lot too, so it's quite important for our economy and certainly for the Fed's work and other government agencies' work that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're showing coming in, showing no significant upward trend in inflation over the past 6 months, that the wait-and-see approach for inflation is actually giving companies cover to raise prices?
How concerned am I that say that again?
The wait-and-see approach is giving...
The wait-and-see approach, what do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait-and-see approach.
Well, so that, that's where policy's restrictive. When we start cutting, it'll go toward neutral.
Okay. This delay, though, where you're saying there's a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving, some companies will certainly be taking advantage of the fact of the tariffs and all of the discussion of how they're going to, companies will raise prices when and as they can. And you saw it famously in the first administration of President Trump during those tariffs. Washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like washing machines. So companies will often just they'll cross the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like Treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, then that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. We've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Chris.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
I mean, ultimately, it could be any of those things, right? But if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting. Will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like will some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down
I think
closer to 2?
We'll look at everything. It's, as I mentioned, a pretty reasonable base case is that this will be a one-time price increase. And in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right so we don't, again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire. Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and to what degree that may be complicating your attempts to get inflation back to target. Thank you.
So this goes back to the division of labor between the Fed and the Treasury, as you, I'm sure, know. And the Treasury only speaks to the dollar. It's not something that's been a topic of major discussion at all at the Fed. I wouldn't say it doesn't come up. If the transcripts, when they come out in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the U.S. economy? Thank you.
We're monitoring the situation. We do, of course, I mean, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But we really need, the government data really is the gold standard in data, and we need it to be, to be good and be able to rely on it. And we're not going to be able to substitute for that, but if we'll have to make do with what we have, but I certainly hope that we get what we need.
Jay O'Brien.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that, I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us, and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks, and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Maria Eloisa.
Afternoon, Chair Powell. Maria Luisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper-income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level, and delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing, but so generally, if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate, but it's true, and it was, again, right in line with what we expected, the GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can be can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed, and we're watching it closely. But we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about this sense, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you've said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But look, I think what we know is that private sector job creation, certainly in the last report we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, it may be even lower, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So it's in balance, oddly enough. You've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that, because of immigration policy, really, the flow into our labor forces is just a great deal slower. And those two things have slowed more or less in tandem. If you look at things like I mentioned, quits, look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Nancy. Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about exactly what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So, we have an economic go-around where people talk about the economy, and then that's yesterday, and then today we have a monetary policy go-around. All the way around the table, everyone gives their views. So the discussion around policy was, the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express, I won't tell you the reasons. They'll issue some kind of a thing in the next day or so. So, but that's the story, and I would say, well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where, unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock, and it's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
And you've said you're waiting to be confident inflation is heading toward your 2% target before you start cutting rates. When you do get that confidence, would you be in favor of lowering rates right away?
It's not quite the way I would put it. I said that's why we think policy should be restrictive, is because, inflation is above target. When we have risks to both goals, one of them is farther away from goal than the other, and that's inflation. Maximum employment's at goal. So that means policy should be tight, because tight policy is what brings inflation down. If you came to the view that the risks to the two were more in balance, that would imply that policy shouldn't be restrictive. It should be more neutral, a neutral stance, and that would be somewhat lower than where we are now. No one knows exactly where that is. So that's the framework I think I'd be taking, and we'll just have to see. We're going to be obviously looking at a lot of data in the next cycle. It is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us.
Jeff Cox.
Thank you, Mr. Chairman, for taking the question. Jeff Cox from CNBC.com. A metric that you like to cite a lot is the final sales to private domestic purchasers. That was down to a 1.2% gain in second quarter from 1.9% in Q1, suggesting that there's some softening in underlying demand. I just wondering if you look at that and you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks, that the housing market is in fact weak, and the inflation numbers from GDP today came down to 2.1% for headline, 2.5% for core. I'm wondering how much more movement you would need to see from these data points before you would be comfortable with cutting in, say, September.
It's going to be the total. Hard to answer that specifically. PDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2%. That's the whole half. You mentioned the quarters. So those are slower, but GDP is bumpy quarter to quarter, half to half, and often gets revised, after the fact. The labor market data we still think continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages, still at a healthy level, but moving ever closer to what we would regard as long-run sustainable, consistent with longer-run productivity and 2% inflation. So the labor market is actually still quite solid. Inflation is above target, even ignoring tariffs. It's a little bit above target, and tariffs. So we're watching all of that, and again, trying to do the right thing in what is a challenging situation, because you're being pulled in 2 directions, and you have to decide which of those to go in. And actually, at some point, if they're sort of equally at risk, then you really want to be at a neutral policy stance, which we're not right now.
So it'd be safe to say that if the data kind of stays in line with where it is right now, that you wouldn't be comfortable with cutting in September?
I'm not gonna say that. No, I
just to note that he normally stops talking usually
in many different directions.
3:30, 3:40, somewhere in there.
And the employment data, and we're going to make a judgment based on all of the data and based on that balance of risks analysis that I mentioned.
Thank you.
Greg, Rob, for the last question.
Thanks, Chair Powell. Greg Robb from MarketWatch. The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term as chair ends. And I was wondering if you had any update for us on a decision on that front.
Sorry, I do not have any update for you. Thanks very much, everyone.
All right, that's the end of that one there. If you were able to get long with me, you're green right now. You decide what you do from here. I got long with you in the Discord and in the Pro channel. Okay, so that was the end. That was the end of the press conference. There was a lot said by Jerome Powell here. As we got later into the, I'm going to read a few key points here to you from that speech. Just give me one quick second here. Powell started off by saying that uncertainty more or less. Hold on one second. I got to answer a question. Hang tighter. Sorry about that. I have to answer some questions inside the Discord really quick. Excuse me. I got some gas. Okay, so Fed's Powell, uncertainty more or less even since last meeting. He goes on to say that Trump. Oh no, hold on. I got the wrong people here. Hold on here. I got a lot of stuff I'm reading through here. The main number you have to look at is the unemployment rate. Agree with that. Downside to labor market are certainly apparent. You don't see a weakening in the labor markets. Demand and supply for workers are coming down at about the same rate. So there's a couple of things here you got to read through the lines here in some of this stuff. So unemployment is not bad. He mentioned that. He did mention, though, that demand and supply for workers is coming down. That's true, and that is a negative on the economy and the market, but there is no trend established just as of yet, so I wouldn't put too much weight into it as of today. He did go on to say there are many uncertainties left to resolve. Later on, he says, break-even number for job creation has come down. Decline in labor supply and demand suggests downside risk. So he's telling you already, don't be looking at unemployment numbers, be looking at employment, ADP, JOLTS. Those are the numbers to be watching over the next 3 months, or even more, maybe from now into December, February, even into February, and even into summer of next year. He goes on to say the economy calls for modestly restrictive stance for now. Modestly restrictive stance for now. He can't point to June projections 6 weeks later. My own estimate is modestly restrictive. There are a range of estimates. So he's addressing this, saying that there is some risk in employment, but not unemployment. He goes on to say, we know the neutral rate by its works. We have to think of this as still quite early days in assessing the impacts of tariffs. Listen to that closely. We have to think of this as still quite early days, in assessing the impact of tariffs. I talked to you about this earlier, right? We're in the early days. We still don't have tariffs finalized, and we still don't know the ultimate impact of tariffs if they are persistent or sticky. Powell goes on to say the range of views of what neutral rate is at this moment, and we'll be making that judgment as we go. You know they've never gotten to the neutral rate, right? No, I don't think in history they've ever gotten to the neutral rate. And when they have, it's gone into stagflation, right? Below zero. And every time we're in there, you end up getting help from you end up getting free money, basically, to restart the economy. Traders, hold on one second here. We think there's a long way to go to know where we'll be on impacts. I expect to see more tariff impacts in tariff data. So he's telling you to watch what? Services? I don't think so. He's telling you to watch durable goods inflation. I will say something. Durable goods inflation does not look bad right now. But he also knows that the impact of 15% is not priced into the market. About 10% is, but not 15%. Today you got a tit-for-tat argument from Trump to a country saying we're going to do 50% on this country. And I'm assuming they responded to him and said, fuck you, fuck off, right? Fuck you and your offer. That's not the last offer. We're going to do tit for tat. That was earlier this afternoon. Powell goes on to say, I expect to see more tariff impacts in inflation data. That's negative. He goes on to say, tariff pass-through to prices may be slower than thought. You could say the Fed is looking through inflation by not hiking. So his point here is the one that I made to you earlier. If anything, the Fed could raise rates. And he's telling you we're looking through that at the moment. Why is he saying that to you today? He's saying that to you today because right now, if these weren't tariffs, he would be hiking right now. Your inflation numbers are rising across the board, but more so in services. And we have a natural cycle of inflation coming. If you watched oil this week, it picked up in value, didn't it? So he's saying that, by us not raising rates right now, we're kind of giving you a cut, even though the rate is, or the hike cut is neutral at this point. He goes on to say there may be some stimulative effect from the tax bill, but not a major one. Not a major one. He didn't address, or they didn't ask him this question, which I would have asked, which would be China is printing money right now. Tons of it. And that money will find its way into our economy, even if we are not getting this huge bump by taxing or less taxes, more spend. There may be some stimulative effect from the tax bill, but not a major one. He goes on to say he doesn't see the fiscal bill as particularly stimulative. That is shown in the 30-year bond if you're already looking, right? The spending bills are telling the 30-year bond that we're going to have a problem down the road, aren't we, from all this spending. Fed's Powell says doesn't see fiscal bill as particularly stimulative. It's probably in relation to down the line the impacts on our economy, that we need to tighten the belt strings, right? And we're not doing that currently. He says we do not consider the cost of government of our rate changes. Traders now no longer fully priced in a rate cut in October. I don't think you get one. I think that they dangle it in front of you, right? They're like, yeah, you're getting a rate cut. I don't see any rate cuts. I think your real rate cuts happen summer of 26. Best bet. We can't separate out the tariff effect on inflation. Inflation is most of the way back to 2%. There's catch-up inflation reflecting past pressures. Services inflation is coming down nicely. Goods going up. That's not true. That's false. He's lying. He's lying to you. Some companies will take advantage of tariffs. What we see now is the very beginnings of tariff inflation. We have long-term housing shortages and haven't built enough. We have risks to both of our goals. He says the next steps we take are likely to be closer to neutral, i.e. cutting. So he's telling you right now, just in this right here, hey, we're not going to raise rates on you, but we have justification to raise rates. He also thinks that by not raising rates, that inflation is going to run higher. And you're going to see the next, rate cut or a rate increase likely be a cut, if not more cuts. And those cuts will come because of what? Why would those cuts come? Inflation rages out of control, right? Inflation rages out of control. We're trying to get the timing right. A pretty reasonable base case is that this will be a one-time price increase. The dollar has not been a major focus of discussion. Consumer spending has been very, very strong the last few years, and now maybe it has finally slowed down. Consumer spending is worse than it was. That is true. But the consumer is still, I told you this earlier, that the consumer is still resilient right now. He did change some of that language, but they're not in a bad place. If there was like a 10 where consumer was great, that was right when Trump became president. Where are they at right now? Probably a 6 if I had to guess. If 4 is bad, they're at about a 6, maybe 6.57. Wages aren't bad right now. There's no unemployment. There are jobs coming down right now, job offers, but I don't see it as, hey, we're going to go bankrupt. I don't know. We're going to go foreclose in our home and we're going to be living in a car. Oh my God, my wife left me, took the dogs. We're not at that stage at this moment. So the consumer is not quite out of it just yet. Private sector job creation, the last report had come down a bit. That is important. I'm telling you, like job creation, job offers, any new jobs, all that stuff has not been looking good. So he acknowledges that. Totality of labor market data shows solid market, but you have some downside risks. I agree with that statement. In the discussion around policy, the majority view was that inflation is above target, employment is at target, policy should be somewhat restrictive, expects dissents to be explained in a day or so. So they're going to get some explanation here in the next day or two on the dissenting opinions. Inflation is further from our goal than employment. We get 2 employment and inflation reports before next meeting, and we'll see where that takes us. GDP is a bumpy quarter to quarter and is often revised. We think the labor market is the best economic data that we have. I agree with that too. If you're looking for like one data point, it's always employment and unemployment. Never like, or it's other things. You can say it's inflation to GDP, And there's a couple others that you could look at, debt to income, and you could also look at deficit, debt. But all those things aren't glaring. I don't think anything's glaring, but if anything was glaring, probably employment and inflation. Those are the two right now that are standouts. What else do we got here? I think that's all I've got here. Well, Trump just kept talking. Like I got Trump slaps universal at 50% tariffs on copper imports. Metals price plunges. That's not good for tech, is it? Dr. Copper, not good. And you saw the plunge today. I had a target right here of a low. Remember, this is a 1 minute chart, but I had a target down here of 634.51. They came down and blasted right over here. I actually added longs here. That's why I typed it out for you. I came in here and started buying right in here. Still long right now. And I got longs from yesterday. But I did add longs inside of here today if you want to know. Now, what else do I have on this? I think that's all I've got. I don't think I missed anything. I think that's pretty much the gist of what he said. Now, the takeaway from all of this is the takeaway from all of this FOMC and in particular. Hold on a second here. I got to get some Tums or something like that. I had a bag. I didn't eat. I was supposed to go out to eat last night, missed eating, got caught up, and then this morning I ate a bagel, but I haven't had anything to eat in like 36 hours, something like that. So I'm like, my stomach's dying over here. I've been drinking coffee and water, and I had sex this morning. I fucked this morning. Shouldn't say that publicly. So I've been like sweating. Then I worked out in the middle of this thing today, so I'm like, I just need something. The takeaway from this that's important for you to understand is this. I want you to, I know that some of you out there, I know that there's like a group of you, probably 70% of you, with two ideas about the Fed policy that are wrapped up in either politics or what you think needs to happen that is not based in reality in any way, shape, or form. I'm going to tell you that. If you're watching, this is not the way for me to get followers, is it? 70% of you out there watching this show right now are either underinformed, misinformed, not educated enough, just don't have enough information, or are being poisoned by what you're reading in Wall Street Journal, Bloomberg, CNBC, and it's not your fault. FinTwit, you're being sold sizzle, and a lot of it doesn't have any kind of editorial oversight for truth. That's true. And because of that, it's not your fault. I don't blame you for it. I'm telling you that it's bizarre to read and watch and read a lot of what is said about what's going on right now in general. What's going on with consumer, the hard data, the soft data, and what is going on with the Fed's response to all this. Now, you might hate Powell, and I don't like him particularly either. We are here because of Powell. It's not fully his responsibility, but that's the Fed's responsibility, right, to some extent. So I'm in agreement with that. But what he's doing right now, I don't know why he's doing that. I don't know if it's because he's fighting with Trump or whatever. But what the Fed is doing right now, and the Fed in particular, is doing a great job. You got to give him this. And what he's saying to you today is probably the closest to truth you're going to hear right now, publicly. There's a few other voices out there that talk about this stuff, but he's probably the most truthful I've heard him in a long time. Recently, the past, I'd say since 2022. I'd say since fall of 2021. He's become more, oh shit, we're fucked. We might blow this whole thing up. This is all fallout from COVID. And they probably didn't want a repeat of the 2008 financial collapse, like part 2. And there was a real possibility of that happening. And what he's saying to you today is in line with where the data is. I think he's being gentle and nice, to be honest with you. to the market. The market needs a hike. It really does. We have not slowed spending, but we've slowed it. We've not stopped inflation, right? We haven't caused major unemployment, have we? So we haven't done enough like huge damage yet, and there's still looming shit out there. There's still shit from COVID. And on top of all that, we have what Trump has done, right? It's not his fault. I'm not blaming Trump, but Trump has lowered taxes. He's raised the deficit. He's raised the debt limit. Huge. And those things have to be accounted for. To not account for those things is insanity. Pure insanity. And so I think not Trump. I think what Powell is saying today, probably the best that they can say. Now, as far as does the Fed actually impact inflation or unemployment, I don't think so. When I've read books, autobiographies, and biographies from prior Fed chairs, they have readily admitted that they do not believe that they're the instigator or ending of any cycle. They hope that they're jumping in to amplify or squash the worst effects of those cycles. I am a little perturbed that he hasn't mentioned today that we're coming into a new inflation cycle. I think that that's the one thing that no one wants to talk about. Nobody. I don't hear anybody talking about. There's a few people I hear. Couple. Two. But there really is a new cycle of inflation that we're running into right now. And if you remember when he said in the prior FOMC where he was trying to get the business cycle from COVID back in line with the normal business cycle, they were successful at that. And the moment we started saying we're going to cut taxes permanently, we're going to raise spending, that threw a fucking monkey wrench in that shit. I'm telling you, whether it's good or bad. I mean, I'm not necessarily against tariffs. I'm not against bringing manufacturing back to the U.S. I agree with that. I think it's dangerous. I am afraid of China. When you look back at COVID, if they cut us off, we'd be fucked. How we're going about it, I don't agree with at all. But I understand why we're doing it. I understand the reasoning for why we're doing it. So I'm not really I'm kind of agnostic to what's happening. And I think that Powell's agnostic to it too. But you got to give him credit for having to absorb all of that stuff and manage all of that stuff. And it also throws a wrench into some of these cycles that we're in. There's a little bit of a wrench thrown in. Get things in line, and all of a sudden you throw a wrench in, and you got to deal with that stuff. And that really is rearing its ugly head, this new cycle of inflation. And I think he said that inside of the speech today. He was like, yeah, we'll be cutting a lot at some point. And I think that he's giving you a measured balance, like, hey, we should be raising here possibly. That would be really over-tightening. I don't know yet if we need to or not. I can't tell if this new inflation is cyclical or if it's tariffs. Is it spending? What is it? And there's been no mention of China either with what they're spending right now, which I want both of those addressed. I want to know about the money that's being printed in China right now and as that impacts our society, because that money will make its way into the U.S. too. And then you've got the cyclical inflation that nobody wants to bring up. You'd panic everybody if that was the case. So they're buying time, and to some extent, in my viewpoint. They're buying time. I think he's going to drop a fucking bomb inside of this new Fed chair. Let me bring this over here. Sorry about that. I think they're going to bring a bomb to the next Fed chair. I really do. I think that next Fed chair, when they come into power next year, they'll be ready to cut. 100%. All that shit will be raging. And you've got a president that's telling him to cut while all this stuff is it's going to grow and grow and grow and grow. So he's in a pickle. And I think he mentioned that he kind of skirted around that stuff today where he was in this pickle with it. But, it's what it is. You can only say so much without pissing everybody off or freaking people out or whatever. I'd probably give this speech, from my perspective, I'd give it I want to say an A- or a B+. Now, the initial reaction here is negative, right? Price action is lower. We're not higher. We hit our first upside target. We hit our intraday target to the upside. And I think we hit 33% of it. And we hit daily trend. And we know where the bears are, right? We know where they are. They're sitting right here. We came back down here, and inside this interview, we got kind of a negative reaction, didn't we? Knee-jerk bad reaction to what the rest of his speech had today. They didn't like it, did they? Now, is that knee-jerk reaction bad for the stock market is the bigger question. In my view, it is not. In my view, this is good for the stock market. I think the bond market is happier hearing this stuff. These are the things that the bond market wants addressed that are, hold on here, that is not addressed. Absolutely not addressed. Now we await the close today for Meta and Microsoft reports. It's now 3:40. We're going to get the reports at 4 p.m. Let's see if the market recovers here on both of those reports, or if we sell down and start the unclench into the weekend and the third. I'll be right back with you in 5 minutes. I'm going to take a quick break, go potty. Got to go pee really bad. I'll be right back with you guys. Wait, what do you got there? Hold on, I'm reading what you're saying here. So Powell is out in May, and another governor is retiring in 26, with two people now wanting to cut. The two Trump appoints will be on board, obviously, at the very latest. May 2026 is cut-or-rama time. I think they'll have no choice but to cut. I think they'll come in, and the market's going to be on fucking fire, Sticky. I think I think what you're going to see is a failure to get a new all-time high from the spring low of 26, and we're going to roll down, and then we're going to start. It's going to get bad. You understand how I'm saying that? You'll get an all-time high in the December through February, and then when we roll down in the spring, the upside summer trade will not make a new all-time high by the time we come to this part of the market where we're about to roll over, and then we're going to go take a bloodbath, a jackknife to the downside into the fall, and then you're going to be doing tax loss harvesting. And in concert, you're going to get a repetitive cuts at that period. Like that May, June, July, you'll start seeing that guy or gal or whoever that is start cutting. I think he's setting them up for it. I think he's doing the most responsible thing that he can do before the shit show starts. No, I don't think you'll see him in March. You got to remember, you got to change the sentiment. The sentiment won't be negative in March or April. The sentiment will only turn negative if you don't make the new all-time high in summer. If you fail that next summer, sentiment's going to go down to the shit turds. Market will start selling hard and heavy, and they'll demand cuts. There'll be no choice. My target for the top is December 31st to February 18th. I'm leaving a big, wide capture there. I've been fucked over doing that. So if I try to time my longs into like December 31st, I watch them get printed in February. A lot of the market has changed, metamorphosis, in the last 6 years or so. You remember like the sell in May shit? That's all fake. That's all bullshit. And the prints are coming. What they're doing, I think, is they're taking I think that what they're doing, or I think what the market is doing, Wall Street, is they're buying the fall dip, and they're pushing out their prints from the usual December 31st into mid-Feb. I would put them out to mid-Feb and then try to wrap them up by December 31st. But if you don't catch it, Like December is now very volatile. It used to be one of the best returning months. Now it's like a bunch of volatility. Yeah. There are a lot of market changes right now that are terrible, or not terrible, or a lot of the old market idioms need to be adjusted a little bit. $1,600. I will have the charts up for you for Google or for Microsoft and Meta here in just a few moments. I just got to set some stuff up. Hang tight, guys.
One minute now until we get the markets on close imbalance. 10 seconds. Markets on close imbalance. S&P 500 sell side 281 million, Nasdaq 100 buy side 888 million, Dow 30 sell side 55 million, Mag 7 buy side 296 million. So just keep in mind, following the closing bell today, earnings season continues. So we have Qualcomm reporting their earnings first at the top of the hour. Estimated EPS of $2.71 and an estimated revenue of $10.33 billion. 5 minutes past the hour, we get some more Magnificent Seven names reporting their earnings reports. Firstly, we get Microsoft printing Q4 25 earnings with an estimated EPS of $3.37 and an estimated revenue of $73.89 billion. We also have Meta Platforms printing Q2 2025 earnings with an estimated EPS of $5.89 and a revenue estimate of $44.83 billion. So at the same time as this as well, also at 5 minutes past the hour, eBay due to be printing Q2 2025 earnings with an estimated EPS of $1.30 and an estimated revenue of $2.64 billion. Ford printing Q2 2025 earnings, estimated EPS of 33 cents and an estimated revenue of $44.14 billion. Trump says, "We're very busy in the White House today working on trade deals. I'll be meeting with the South Korean trade delegation this afternoon." Trump says South Korea is right now at a 25% tariff, but they have an offer to buy down those tariffs.
Can I go to earnings instead, maybe?
Trump says we just concluded a deal with the country of Pakistan.
Hold on here. There we go. There's Microsoft. Bring this over here. There's Meta. Here's Spoos. Microsoft cranking right now. No. 1605 is when they report. I think 1605.
Trump says other countries are making offers for a tariff reduction. So Trump, more color on Pakistan, says Pakistan and the US will work.
Microsoft cranking into the half-hour trigger right now.
We're in the process of choosing an oil company that would lead this partnership. So in 5 minutes' time now, at the top of the hour, Qualcomm due to be printing Q3 2025 earnings with an estimated EPS of $2.71 and an estimated revenue of $10.33 billion. Also in 10 minutes' time, at 5 minutes past the hour, Meta due to be printing Q2 25 earnings with an estimated EPS of $5.89 and an estimated revenue of $44.83 billion. Microsoft printing Q4 2025 earnings with an estimated EPS of $3.37 and an estimated revenue of $73.89 billion. eBay also due to be reporting estimated EPS $1.30, estimated revenue $2.64 billion. And Ford estimated EPS of 33 cents and an estimated revenue of $44.14 billion.
Where am I at in the market? Here we go. Meta squeezing higher into their close. Or Microsoft Meta a little weak here. SPY recovering. Q's recovering right now. Note that Q's is coming into its hourly trigger. Above at 568.28. SPY now squeezing higher, trading 633.97. SPY now trading 634.46. Q's trading 56.03. No movement yet from Meta. Microsoft, I have them. I have Microsoft giving less of a return today than Meta.
Qualcomm earnings.
I've got them hitting the 3.5%, but that's it. Yeah, there you go, Spoos. Come on back, baby. Come on back. Come on back. That bullshit candle down there. There you go. Get right back up in there. You dirty fucking... Hold on here. Let's get rid of this line here. We don't need that. Bullshit down there. Fucking... Get rid of that right there.
10 seconds.
There we go. There we go. Give me some reports. Yeah, give me that big green fucking...
Just DPS of $2.77, a beat on the estimate of $2.72.
Oh, Microsoft.
$10.37 billion. A beat on the estimate of $10.33 billion. and a 9-month capex at $785 million. They see fourth quarter adjusted EPS of $2.75 to $2.95 compared to the estimate of $2.84. They see fourth quarter revenue of $10.3 billion to $11.1 billion compared to the estimate of $10.61 billion.
There's a lot of shit coming across the wire right now that I'm reading, and I'm like all over the fucking place. Qualcomm fucking smashed it out of the park. Qualcomm moving higher right now, trading 160.33. SPOO's ripping to the upside right now.
Just a reminder, 5 minutes ago now, to get Microsoft Q4 2025 earnings with an EPS estimate of $3.
Thank you for the discount, by the way, market.
Of $73.89 billion. Meta,
they just went downside on Qualcomm right now.
Estimates of EPS estimate of
they're running both sides of the
revenue estimate of $44.83 billion. Ford second quarter estimates forecast for the EPS of 33 cents, a revenue of estimate of $44.14 billion. eBay second quarter 2025 earnings EPS estimate of $1.30 and a revenue estimate of $2.64 billion.
You are green right now. You should close and switch out of zero dates because you need to understand the. I think we're fucking mooning, dude. I think we're mooning in tomorrow. I'm afraid of you. Like with zero dates, if you get a big fucking directional move, I try to get out and back in, out and back in, out and back in. One day, they're all the same these days. They're all fucking they're all like a fucking 1 and 3 date or like a 0 date. How the market moves, it's only worth trading zeros for the direction or all day long.
On Qualcomm
if you're trending in a certain way.
Extended trading after
Microsoft
results. So just the way we're
yes.
Try and go with Microsoft and then Meta, and then
take your money and run.
Microsoft EPS. EPS of $3.65. That's a beat on the estimate of.
I mean, when you get a move like this, I would say take the money and run, wouldn't you?
26.4.
That's what I would say.
A beat on the estimate of 70.
Microsoft, what are you doing, you dirty dog?
Revenue $29.88 billion. A beat on the estimate of 29.
Q's. All right, I gotta go.
And other.
Take your fucking money and run.
Plus 39%. Yeah, that's a beat on the estimate of plus 34.2%. So Microsoft.
Oh yeah. Oh, Microsoft. Yes. 637.50 right now on SPY. Thankfully, we didn't trade Qualcomm today. We got to hit every one of these fucking things. SPOO's just traded all the way back to the drop from the top, trading 637.16. The high of the day was 637.67. Yeah! Catching a discount. We're waiting for Meta to smash it out of the park next. We'll see if Meta can bring up the rear right now. Betcha a bunch of bears wearing puts at the bottom down there. Like, that guy's getting long down there, and I'm getting short. For the other way to the upside. Meta trading 548 and change. Still no report from Meta yet. If they come in with the uppercuts, we know what's going to happen, right? Smash it, baby. SPY trading a high of 637.22. Come on, Meta. Don't let us down, Meta. I've got you going up in a big way. You've got a 5.6% move scheduled for today.
Meta, Ford, and eBay. Ford coming through with cute second quarter adjusted EPS.
trading with the pro channel right now.
With Meta second quarter EPS of $7.14, a beat on the estimate of $5.89. So again,
Meta going to the moon right now. What are they trading? Whoa, trading 729 right now. The dealers don't want SPOOs going higher, do they? Look at SPOOs right now. SPOOs just being held back right now, isn't it? Get up there, SPOOs. Meta trading 734 right now. Rips on both Mesfit and Meta. If you bought the underlying, like I told you earlier at 1 p.m., congratulations. Both are going higher right now. SPY now trading 637.93. Got a high at 637.26. You know they're short up here, right? Let's go up there and smack them around a little bit and take all their shorts.
$47.15 billion.
SPY trading 637.20 right now. 637.30 right now and a high. Meta trading 734.
In the range of $47.5 billion to $50.5 billion.
Green bars, do you love it? Take that. If you're a dealer, take your fucking finger off and stop selling. Get me 640 by tomorrow's open. Give me the high, baby. Give me $2 more. Keep on going.
218.
Meta smashing 740 right now. Misfit only expected 3.6% move. Meta was expected 5.7%. Underappreciated Meta to the upside. Taking it uptown.
5% after third quarter revenue.
Now trading 743, 745 almost.
Fiscal year
Woo!
66 to 70.
SPOO's fighting again with the daily high. Let it through. Open the fucking door. Let it happen, baby. Someone give me the fucking lube. Get me the lube. I want to slip it in. Nice and easy on SPY. Show me 640, baby. SPY trading 637.47 right now. Talk about a recovery down there on the long and the downside. I'm down there writing to you to get long, and what did you do? You didn't get long, did you? You bought puts at the bottom again. Trading 637.58 just then on SPY. 637.61. Give me that giant fucking squeeze. Look at Meta going off the chart right now, trading 7.52 right now. Q's breaking out to the upside right now. Just had an intraday high on SPY. Take some money off and get out of there. Take the money off right now and get out of there if you're with me long inside the Discord and the Pro channel. Take the fucking money and run if you have diamond hands. Do it.
Just EBIT of $6.5 billion, $7.5 billion.
Take the fucking money and run.
And the second quarter,
take the money and run.
$1 billion. A beat on the estimate of $1.91 billion.
Fucking dealers.
CapEx
take the money.
$1 billion.
Take the money. SPOOs. New daily high. Another opportunity to hedge the market. 631.71. Just when they thought they fucking had it, they don't have it. We have volatility, not bear time. Volatility. Range trading, baby. Stay on the edges. Get long. Get short. SPY with a new high. 637.71. God damn it, I did my job today. It ain't easy.
Also, with eBay earnings coming through, so eBay sees third quarter just EPS of continued OPS of $1.29 to $1.34. Estimate was $1.31.
It ain't easy pulling money out of this fucking market.
EPS.
I shit you not. It's like closing bell 4:15, 9:30, fucking FOMC for fucking 2 minutes over here at the top, 2 minutes at the bottom, 2 minutes at the top. Oh, yes. I want to wake up with a gap up on Thursday. I want that big green fucking day today to close big ass green. I want the fucking sideways and another up move into Friday. I want this week on green. I want the month on green. I want the 3 top performing months to come out swinging. to the upside.
So second quarter gross merchandise volume of $19.51 billion.
If you ever want to trade with us, I trade with my Discord. I just traded this whole fucking move right here from bottom to top in our Discord. I will pay with those trades your whole year membership with the money that you make. I'll be back. I'm going to take a quick break and I'll do a private stream with the Discord in about a half an hour.